It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 almost totally unchanged. The jobs report 1 hour away, 60 minutes away. The number we're looking for is about 220K. With 2 hours until the cash open with your morning movers, here's Manus Cranny. Good morning, Manus.
John, good morning. This at Lululemon is a story of not US exceptionalism, but Chinese exceptionalism. The stores overseas are doing phenomenally well. Chinese stores rose by 39% sales there. They've upped the guidance for the year. They're going to make 10.45 to 10.49. But the conversation you've just had with Forrester a little bit earlier, it's about the preservation of premium pricing. Don't end up in the bargain bin. And that's what Lululemon are indeed achieving. Gross margins of 58.5%. So yeah, the international side of the business is doing a little better than the US. The US business, they say, will continue to underperform. There are macro pressures and headwinds out there. I never thought I could get excited about leggings, but there you go. We fitted it all in. A little bit more fitness for you, Peloton. I remember the days when we went into lockdown. People were scrambling to buy these machines, and then it was a bit of a tortured volatility period for them. Volte-Face by one of the houses out there, UBS, has quadrupled their price target. They've capitulated. They've gone in. They say it's going to be up to $10. You've only got one sell left on this from BNP Paribas and underperformed. Go Peloton. I'll leave you with a light touch of beauty. There you go, Ulta Beauty. Just think of the competitors here. You got Sephora. You got all the others coming in like Walmart, Target, and Amazon. But they have raised their guidance for the year. So it's going to be a raising of the guidance. They blasted through in the earnings per share, $5.14 to up above the estimate of $4.53. So the pendulum is swinging very much in favor of this company. And Data, Telsey, friend of the show, she's raised her price target to $500 from $450. So there's still 27% left in the tank. Beauty and health. What more do you want on Jobs Day?
That's enough for me. Max, thank you very much. Appreciate it. 3 of the winners so far this morning. The opening about 2 hours away. The jobs report about 60 minutes away. Under surveillance this morning, Elon Musk and Vivek Ramaswamy making rounds on Capitol Hill, building enthusiasm for their efforts to slash government spending. Both meeting with key congressional figures, including House Speaker Mike Johnson and incoming Senate Majority Leader John Thune.
So the question is, can they Dogify the government? And this is where it becomes very difficult in terms of spending. One thing they want to do is make all these federal workers come back to the office, even though the Biden administration appointee of them is actually working on potentially allowing some to already have a mandate to work from home before Trump comes in for some government workers. But the big piece of the pie, the chunk of what the U.S. spends money on is entitlement programs, and they are very popular. How difficult is cutting from that going to be?
I find it interesting that they're going after jobs to be an interesting aspect of this, because kind of unsaid in this whole, or actually, sorry, explicitly said in this you need to go back to the office, is it will lead to voluntary people quitting, that you're going to have less people working in the federal government. What does that mean when right now it is the federal government that is doing the hiring at this moment? Priya Misra was just talking about it, this idea that the jobs number would have been negative for last month if not for the government? If all of a sudden you're letting go of large swaths of the workforce, one, how much appetite is there for that? And two, what does that do to this macro environment?
So this was the memo. The American Federation of Government Employees, a union representing 42,000 Social Security Administration workers, reached an agreement with the agency last week that will protect telework until 2029. This is one of those, I know you want to bring them all back, but at least these 42,000 working for Social Security Administration, we're going to let them hybrid work.
You know, there is a myth for European tourists, and I speak directly to European tourists because once upon a time I was one. They would come to America, they'd look at the infrastructure and they'd say, Americans really don't pay enough in taxes. They need to do something about this. And then you move to America and you speak to the accountant. They start going through the taxes you're about to pay. You're paying close to 50% in many cases here in New York City. City tax, state tax, federal tax, some other taxes as well. We need to do something about what is going on or not going on in Washington, D.C., which is why so many people are on board with this effort.
Right, because they say there is just way too much spending and we cannot pay our bills. And especially when it comes to entitlement programs, they will be running out. More people are retiring. The money is just not there. So they want to see this happen. What I find interesting, though, is what Ed Mills said. The pushback is going to be challenging from people that were in that room, Republicans, because why? The margin is so slim. Historically, it's the slimmest margin Republicans have had in the House.
Let's turn to this story. Trump announcing former Georgia Senator David Perdue as his pick for U.S. ambassador to China. Perdue seen as an olive branch to Beijing thanks to his history of working with the Communist Party in a business capacity. What does this mean for the path forward?
So what I think this is showing is what Terry Haynes rightfully called this, a cabinet of rivalries. You have hawks like Representative Waltz, who's going to be his national security advisor, Marco Rubio, who is sanctioned by the Chinese Communist Party. And then you send someone with a business touch, a lighter touch on China, to go actually sit there in Beijing. What we put out in our story is the selection of Perdue worked in Singapore and Hong Kong, helping American firms actually source cheap labor in countries. This is something that Trump is trying to bring that labor home. So I think what this shows is a balancing act when it comes to China and potentially Trump going back to really who he is, which is a deal maker.
That's the latest on China. This is the latest on energy. Take a listen to this. Chevron planning to slow production growth next year in the Permian Basin. That's America's biggest oil field, reducing capex by up to 10%. This, of course, might be a hurdle for Trump's promise to unleash U.S. crude production. This is some pushback into next year.
But it just shows that Trump can't have it all. Either you have lower energy prices or you have higher energy prices that encourages people to drill. The two work against each other, as does his approach to OPEC. One of them is going to have to give.
Can Tesla have it all? Let's turn to the autos. Bank of America raising its price target on Tesla to 400, citing confidence in growth prospects. John Murphy of BofA highlighting a visit to the company's Austin Gigafactory, writing the trip gave us increased confidence that Tesla is well positioned to grow in 2025 and beyond with its core EV business, launch of its robotaxi offering, and longer-term investments in Optimus. We'll get to Optimus a little bit later, John. Let's start on the car. It's good to see you.
Great. Well, thanks for having me.
What was that experience like?
You know, there were many things in the trip that were very good, but I think the two things that stood out is it sounds like the penetration rate or the subscription rate on FSD are going up, and that combined with our ride in the latest version, 13.2 of FSD, was really impressive. So, I mean, you've put those two together. If that 13.2 continues to improve, I think getting people to pay $99 a month for FSD is going to be a very easy thing to execute for Tesla.
Where is FSD compared to something like Waymo? What's the big difference right now?
So, you know, right now Waymo is working on a level 4 basis in many cities. San Francisco is probably the biggest. So geofenced autonomy, and it's working pretty well. Tesla is not to a point where it's actually even testing at sort of autonomous tech that will come in 2025 in their robotaxi launch. That will be surveilled, if you will, by teleoperators and folks in the vehicle. But as far as what is going on in sort of the rate of change, on a subjective basis here, there is really a massive improvement that's going on at Tesla with FSD. And then sort of on an objective basis, the target of getting to 10,000 miles without any disengagement of FSD is a target by the end of this year, and next year they're going to probably make very significant progress. I think this is one of the few areas that Tesla might be under-promising on its targets.
Well, Waymo did announce in a blog post yesterday that they're going to go into Miami in 2026. Is their first mover advantage to this industry, or can Tesla come and bully Waymo out of the way?
So I mean, I think there's certainly room to play for probably 2 to 3 players in the autonomous robotaxi space. So I think that Waymo is definitely ahead of the curve here versus Tesla. But I think the way that Tesla is approaching this is different than everybody else. Doesn't have sort of a suitcase worth of sensors on the roof of the vehicle. The vehicles will look very normal, and I think consumers will appreciate a regular, normal-looking vehicle as opposed to something that's kind of a Frankenstein-looking vehicle as far as getting into it. So I think that ultimately the way that Tesla is approaching this with the cameras that are already in the vehicle is going to really impress a lot of folks, and it might allow them to shoot the gap and take the lead.
So we have Tesla taking the lead. You have Waymo far behind. Is there a future for Uber and Lyft in this?
Well, I'm not an Uber and Lyft analyst, so I'm not going to comment on them directly. But I think the companies that own the software and the hardware together are going to ultimately probably be the winners, and that would include GM with Cruise.
So you said that you think actually in terms of things like robo-taxis and the rollout of this is underpriced right now in Tesla. What kind of targets should we be looking at?
So I think the launch of the robotaxi fleet next year and seeing these vehicles operate truly on a semi-autonomous basis with the teleoperators and the safety drivers, I think is going to be the next proof point. Understanding the launch of the Cybercab, which will probably be in 2026 itself, will be very, very helpful. But I also think, and this is very interesting to the Doge story on Elon's involvement, is the idea that we may get somebody in government that understands we need to increase the speed of travel. And this technology is opening the door to something that I don't think anybody in the markets really fully understands. And many people, really nobody is talking about at the moment, is the speed of travel needs to go up. And this technology, if it creates vehicles that cannot hit things, should allow for the speed limit to go up and the real economic growth to take hold. So you need somebody in government to sort of bend people's minds with the development of this technology and really create something that we saw from the introduction of the Model T in 1908 to 1927, when the number of miles in the United States went up 125 times. 125 times. We need to focus on this, because otherwise the economy is going to be stuck in a 1 to 4% GDP growth rate. We're going to lose out to the Chinese on scale. This is the technology that the U.S. needs to embrace and change the speed of travel so we can compete with the Chinese auto industry. Otherwise, it's done.
Do you think Musk and his proximity to power, what he's doing, he's in Congress, he's probably going to be making a lot of trips to the White House as he is to Mar-a-Lago. Do you think that that will be the force the government needs in terms of some of this deregulation and thinking about things like this, the speed?
I think it's probably just beginning. Tesla has not even sort of expressed this view of increasing the speed of travel, and they're making it easier, cheaper for folks to get into robo-taxis. But I think this is the kind of things that certain DOT programs at the state level are working on. I think there has been some thought around this. But I think this needs to be sort of the precedent for whoever replaces Buttigieg, whoever who has not even thought about stuff like this. Not to be critical of the past administration, but we really need people to open their minds and really think about this, because otherwise we're not going to make a lot of progress. I mean, the speed of travel on our computers has gone up 7 trillion times in the last 10 years, and our speed of travel on the roads has gone down because of traffic. I mean, it's there's all sorts of social good and economic good that comes out of this, and it's just kind of bizarre that the industry and the government can't actually see this at the moment.
What's your vision of the future? What is the destination here? The current travel picture sounds a little something like this. You go to the DMV, buy a license, get a car, or rather get a license, buy a car. Or you travel on public transport, or you hail a cab, yellow cab here in New York City, or you get an Uber. Are they all going to merge? What does that look like in the future?
So it's a very good and important question. I think over time you're going to see somewhat sort of a hybrid system still in place, where you have public transportation, you have fleets that are operated by fleet managers and still individual owner operators. The fleet management might expand out a bit, but as you get into suburban and rural areas, you're still going to have the individual owner operator in place, and that may include some of those vehicles dumped into or sort of opting into fleets like managed by Tesla, over time. So I think there'll be a hybrid there. But I think if you get to a point where you can get that speed of travel up significantly, even if it's on interstate highways or if we organize traffic patterns here in the city, so the millionaires and the regular folks are moving faster because everybody's losing in the traffic patterns that we see right now. Everybody could win. That you could really change activity. And the reason I kind of bring up the interstates is because in 1956 we had the Interstate Highway Act, which is the last time we actually had any real improvements on the roads in the United States. This is really important stuff for the U.S. economy and sort of politically or geopolitically. That as you look at this, you start opening up swaths of real estate that are not available to folks right now. Because you can get there farther and faster. I mean, houses that are 100 miles outside of New York City start opening up to people to commute in the morning. And it's exactly what also happened in New York from 1910 to 1920, when the population went from 2.3 million people down to 1.6, and it's never grown since in Manhattan. So, I mean, there's precedent for this stuff happening.
John, smart, super smart. Whole conversation on autos, and we didn't get to tariffs. We'll do that another time.
Sounds good.
John Murphy there of Bank of America. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Rebels in Syria gain control of the city of Hama in a major blow to President Bashar al-Assad. The resistance group has rapidly advanced south in recent weeks and have their sights set on the key city of Homs, which could cut off the country's capital, Damascus, from the Mediterranean if captured. Any potential response from Iran and Russia will be crucial in determining whether the Syrian president can maintain control. Meanwhile, a U.S. district judge rejected Boeing's proposed guilty plea to fraud charges, which were related to 2 fatal 737 MAX crashes several years ago. The judge said he couldn't accept the deal between Boeing and the DOJ because it would improperly require race to be factored into the hiring of an independent monitor. He also echoed concerns of family members of the more than 300 people killed by the 2 crashes, who'd urged him to reject the agreement and have maintained the penalties are too lenient. And the world's richest man is now also America's top political donor. Elon Musk gave at least $274 million to political groups this year, with most of his donations going toward helping Donald Trump win the presidential race. But that's a drop in the bucket for Musk, who's worth more than $360 billion, according to the Bloomberg Billionaires Index. That's your Bloomberg brief. John?
Hey, Yahara, thank you. Up next on the program, Payrolls Friday.
The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low.
That conversation up next. Live from New York, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No,
we'll do it for fun.
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
"42 minutes away from the jobs report. I think this scene is familiar of what we typically see on the first Friday of any given month. Markets just treading water, unchanged in foreign exchange, unchanged in the bond market, almost dead flat in the equity market. On the S&P, we're down by about 0.1%. Under surveillance this morning, payrolls Friday.
The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low. So everyone is trying to do these very precise estimates based on a number which could just be obliterated on Friday morning. Given the incredible uncertainty that we have right now, any more precise forecasting is just, kind of a waste of everyone's time.
But we'll do that anyway, so here's your latest. Less than an hour away from the November jobs report, with economists expecting a rebound from October's near-zero print. Torsten Slok of Apollo writing this: the Fed has a very asymmetric view on its dual mandate, putting much more weight on low unemployment than on getting inflation to stay at 2%. Torsten joins us now for more. Torsten, good morning. Good to see you. Evidence of that this summer, wasn't there? That they were putting far more weight on the risk that unemployment was going to get away from them.
Absolutely. If you look at the SEP, there is a sub-question that's filled out by the FOMC members where they are asked about what are the risks to your view on inflation, what are your risks to the view on employment. And they have, since this began, consistently said the risk to unemployment is that it will go up in all environments. And that's the worry you can have, namely that if there's too much focus on let's keep unemployment low, that it takes the eyes off the ball of inflation, which is exactly the risk at the moment, where inflation for the last few months in core PCE has started to move up towards 3% again, well above the Fed's 2% target.
We've had a morning full of people worried about the underlying pace of growth in the jobs market. Are you pushing back against that?
Absolutely. I think the narrative is changing in the opposite direction. The narrative for the last 2.5 years has been very simple. Namely, the Fed began to raise rates in March of 2022, and your textbook would have predicted that when the Fed raises rates, you should see car sales go down. That's not what has happened. You should see home prices fall. That's not what has happened. You should see capex spending slow down, and that's not what has happened either. The economy has been remarkably resilient for a number of different reasons. The AI data center boom. We also have fiscal policy from CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. But because of this resilience, and now we're adding some potential from the new administration to do some tailwinds to both economic growth and maybe also from tariffs, restrictions on immigration, and maybe lower taxes, some lift up in inflation. All that is switching the narrative around from we're having a soft landing to, hey, maybe we are either moving sideways or actually having a risk of inflation beginning to move higher.
But the narrative hasn't shifted at the FOMC. What you've heard from Fed speakers still this week is we have room to cut rates. We are still restrictive. Well, that evidence that they're maybe not even restrictive enough or they should stay at these current levels, does that evidence come too late? Do they start to cut and kind of create a toxic mix before that comes evident?
Well, that's really important, Danny, because the incoming data, GDP in the last quarter, Q3, was 2.8. If I look at the Atlanta Fed GDP now estimate, which is at 3.3, that's telling you, where is this restrictive monetary policy? If monetary policy was restrictive, we would have much lower growth. The long-run growth rate, according to the CBO, is 2%. So if we are 2.8, 3.3, around 3 still, even 2.5 years after the Fed raised rates, maybe this whole idea that monetary policy is restrictive is misguided. And I do think that Jay Powell earlier this week, when he begins to talk about we can now be more cautious, is basically a way of backtracking a little bit from this view that, we got to have rates down very quickly.
So maybe next week is the more important week for this market when you get CPI, PPI, import prices, and it's in a Fed blackout period. Are you expecting some massaging of the message from financial media, some stories to start appearing next week?
Well, let's see the data we get here today, but if the consensus is right that we get plus 200,000, again, that's just confirming that there is no slowdown. So I go to lunch with some hedge fund friends once a month, and the conversation is now beginning to turn around. Hey, maybe we could actually have the Fed hiking in 2025. So that's not my expectation at this point, but there's a complete almost ignorance to the fact that the data just continue to be good, and 200,000, 220,000 on your Bloomberg screen in the consensus is not a bad number at all.
So if you're not expecting a hike though next year, potentially could we be done with the cutting cycle?
Absolutely. The market has, of course, gone from expecting a lot of cuts earlier this year, 6, 7, 8 cuts, and now the market is only expecting 3 cuts by the end of next year. And I think the swoosh is coming up more to a straight line, meaning that we're probably going in the direction of the market saying, hey, now, well, let's wait and see what policies we're getting on tariffs, on immigration, and also on tax cuts.
Do you think the Fed, in the next meeting, when Jay Powell comes out, is going to have to start talking about some of these fiscal policies that are going to be coming down the pipeline, given the fact that we've already seen the president-elect talk about them in public and have phone calls and meetings with world leaders about things like tariffs?
Well, and that's why fiscal policy next year becomes very, very important. The Penn Wharton budget model just published a paper this week which was saying very clearly that it is possible to get a turnaround in the fiscal situation and to get back on a sustainable track. But it does require that we grow the economy, we grow the tax base, and it does require a number of political decisions that therefore will be very important in terms of trying to get some more fiscal clarity about what's coming. But it's clear, to your point, Anne-Marie, that we will need to see in markets more evidence and more clarity about what exactly is coming and how much is coming on tariffs, on restrictions on immigration, and also on lower taxes. Because it happens to be the case that if you lower taxes, pushes up inflation. If you put tariffs up, pushes up inflation. And if you restrict immigration, also pushes up inflation. So that's why where break-evens are trading is really a very big surprise to me, because all these policies do point to the risk that there might be more tailwinds coming, not only to growth, but also to inflation.
What do you think neutral is?
I think that it's definitely not at 3% nominal where the Fed is thinking it is at the moment, because otherwise the data should be a lot weaker. So the frameworks that we have, and we try to do the Kalman filters that go into the Laubach-Williams model of estimating what our stars should be, they give a number that's more between 4 and 4.5. So that's not too far away from the 475 of where we are today. So that means that we will likely get another cut or two, meaning 25 basis points. But I do think that the most important thing really is to watch the incoming data. And the incoming data still, in particular, core PCE in the last few months, still suggest that the economy, if anything, is at least moving sideways and maybe even beginning to reaccelerate.
So where does this come from? When Governor Waller, someone we all respect, says things like there is still some distance to go in reducing the policy rate to neutral, what's he looking at?
See, I don't understand that either, because I think that the idea is that in the basement of the Fed that there is a very important and very sophisticated econometric framework, which I totally appreciate. We should be putting weight on our models, but it is just in contrast to what you're seeing in the incoming data. So that's why I think it is the inertia of the groupthink on the FOMC that it just takes time for the committee to come around to changing their view. And that's why Fed speakers more recently have been switching away from saying, oh, it's a soft landing, we need to cut rates more, to saying, hey, we can proceed. Musalem was also saying, hey, we can proceed more slowly. And of course, Jay Powell also saying we can proceed more cautiously. I think all those things tells the market that we should still be positioned for rates higher for longer, which means, of course, in fixed income, cutting coupons, getting nice yields continues to be a good strategy.
Jim Bianco of Bianco Research agrees with you. He joins us a little bit later in the next hour. Still a no-lander. Inflation looks like it bottomed this summer. He says this about the Fed: they shouldn't cut anymore. Jim Bianco just around the corner. Torsten, enjoyed this. It's good to see you. Thank you, sir. Torsten Slok of Apollo. Coming up next in the third hour of Bloomberg Surveillance, we'll catch up with Nadia Lovell of UBS, Jim Bianco of Bianco Research. We'll speak to Mohammed Al-Erin of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. All of that and more. The jobs report, 34 minutes away. The third hour of Bloomberg Surveillance, up next.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with. Upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Kind of number we get today. Andrew Hollenhorst just publishing with this report saying the average of today's reading and October's will determine whether jobs growth is slowing, as we expect, they're at 155, or holding up more solidly, as it is believed by markets and Fed officials and also Torsten Slok.
Fed officials going into the quiet period. I think we all understand the bias. They've conveyed it pretty clearly over the last week or so. They want to reduce interest rates again. You can feel it by another 25 basis points. Things could change a lot. January 20th, when we get incoming administration, President-elect Donald Trump taking over, and on day one, making some big changes.
And this is the big risk, because what if jobs are a little bit weaker and they feel the need to cut, and they say, we're going to continue to cut in force, and they continue to do that until they come head to head with the politics. Does that mean they've already moved too far? Do you get in this toxic brew of you've cut interest rates and then inflation is picking up? What happens at that point?
Toxic brew. Bramo's proud. Lisa's not here, but we're still talking
Channeling
about
her because in her absence. I'm in her chair. I thought
brews.
I would.
It makes sense.
Yeah.
It's allergic. You can like feel it. It sort of drifts around the table. Equities right now on the S&P down by about 0.1%. Contagious was the word, not allergic, of course. Although you might be allergic to it if you are bullish. Equities down by 0.1% on the S&P 500. Coming up this hour, we'll catch up with Nadia Lovell of UBS on her 2025 equity outlook, Mohammed Al-Erin of Queen's College, Cambridge on growing global divergence, and we'll speak to Jeff Rosenberg of BlackRock on the latest jobs data. We begin this hour with the rally losing some steam as traders await one of the Fed's key data points, today's jobs report. Nadia Lovell of UBS looking ahead to next year and writing this, the favourable macroeconomic backdrop continues to support markets, and we expect US stocks to move higher in 2025. But investors should brace for increased volatility due to potential changes to government policies under Trump 2.0. Nadia joins us for more. Nadia, good morning.
Morning.
Bull case, 7K on the S&P. Bear case, a tariff shock 5,100. What does that tariff shock look like?
You know, if we get that universal tariff that Trump has been talking about, 10% across the board, that has implications for not only inflation, it has implications for economic growth. It will be a drag on the economy, and that feeds into earnings growth. I mean, we could see a hit mid-single digits or so to earnings expectations going forward, and so we think that that could create some volatility. And we saw that during the trade wars, right, that the market did pull back. Remember March 2018, right, when you had that first implementation of tariffs on steel and aluminum, we saw the market pull back. And then subsequently in September, as the trade wars got into the heat of it, remember the market was down almost 20%.
He's not in power right now, but he's given us a clean signal of what he wants to do. He wants to put double-digit tariffs on China, maybe even Mexico and Canada if they don't get certain things done. Why is the market so resilient in the face of that at the moment?
I think it's trying to figure out, you know, we're in an era of where we probably will see policy by social media or Truth Social, and it's sometimes going to be difficult to determine the signal from the noise and how much of this is negotiated and posturing. I would say in terms of Mexico and Canada, we're already seeing a reaction when he put on social media 25% tariffs if they don't do something to control borders and also the traffic of drugs into the U.S. And so already those two countries have stepped up and had conversations with President-elect. And so we think that that's going to be more of a stance of escalate to de-escalate. But with China, it's probably more escalate to decouple. And so that's something that we have to be mindful of, that we will see increased tariffs on China, and that has implications for certain segments of the markets that are more exposed to China. You know, you have to think about even parts of tech that has exposure to China.
Well, the so-called good stuff that we're likely to get, that was supposed to start this whole cyclical rally. You saw it after Trump got elected, but since then it's stalled out. It's been the Mag 7 that's led the S&P. It hasn't been cyclical stocks, save for the financials. Small caps are also lower over the past week. Has the Trump trade run out of steam? Is that what we're seeing?
I think part of the Trump trade also got caught up in the strong results we saw coming out of earnings. So I would say some of it was also fundamental. So it's not surprising to see small cap lose some steam because that wasn't really driven by fundamentals. Reality is the earnings growth is not coming through on small cap, and the 2016 playbook is being pulled out. And now you have to think about the implication of tariffs even on small cap. When you look at tech, the news that we've been getting has been incrementally positive. Look at the off-cycle earnings reports we've had this past week. Also, you know, the tone coming out of the UBS Tech Conference this week has been quite positive. I mean, not to have a view on any sort of single stock, but you look at Salesforce this past week, strong top-line revenues, and they have also talked about implementation of AI and seeing some traction within agents, you know, the agent strategy. You know, NVIDIA, no surprise, at the UBS Tech Conference, continue to say exceptional demand for Blackwell. And so we think that the tailwinds for AI is still there. And that's why you've seen the likes of the Mag 7 continue to outperform.
I was going to say, you've had some pretty prominent perma bears throw in the towel without saying they're throwing in the towel on their sort of bearishness, specifically on tech. The idea being, and David Rosenberg said this, that what's getting priced in now is in decades far away. And that's why you can't have these very lofty valuations. Do you buy that just how we value companies has changed?
I do think that, there are some companies that are being valued on a potential pickup in productivity, but I wouldn't put tech in that category because you are seeing that earnings growth. I mean, look at how much earnings growth you're seeing from tech. Next year, you're probably going to see over 20% earnings growth from tech versus what we're expecting for the broader market of, 8 to 9%. And yes, tech is trading at a premium valuation at about a 30% premium to the market, but it's grown at double times. And so I think it's justified. And you are seeing not only the top line, you're seeing margins and you're seeing earnings growth come through, particularly in tech. Some other areas of the markets are there. Could there be some potential frothiness where valuation needs to come down and those companies have a valuation reset? Potentially, but I don't think that tech is in that category.
How vulnerable, though, is the tech industry, though, to something like your tariff shock you were just talking about? I mean, 80% of these semiconductors are made in one place, in Taiwan.
In Taiwan. So we have to watch the implications for Taiwan. We have heard President-elect Trump say that Taiwan needs to play for their sort of own security, and so we're watching that. But at the same time, the president-elect is definitely in favor of American advanced technology and making sure Americans stay at the forefront of that. And there is some reshoring happening. We've heard, in terms of plants being built into the U.S. to be able to eventually manufacture chips, but I don't think that you're going to see that happen overnight. So don't think that the president is going to do anything that's going to be destructive to American innovation, because at the end of the day, we have to be at the forefront of AI in the world. And so I don't think he's going to do anything to do that.
Sounds like what you're talking about is potentially we could see some carve-outs. With your bear case of a tariff shock of 5,100, what happens if we get that coupled with a 15% corporate tax rate if you produce in the U.S.?
Well, then it goes back to how do you define what's produced in the U.S. as well? But if you do get that tax cut, which I'm not sure how that's going to be funded, Anne-Marie, where we got to look for those pennies under the sofa to be able to fund this. And so, but let's pretend that you do get that. It does favor, as we were talking about earlier, the smaller companies in the U.S. because they tend to manufacture in the U.S. And so you could have some offsets with that. But I think that there is going to be a big headwind from tariffs that you're not going to necessarily see that this sort of uplift in the market. We do think that the tariffs will still continue to have that headwinds to the market.
How many bears have you spoken with in the last 3 weeks? Are there any left?
Well, you've been talking to me for a few years. So you've known that I have always been in the bullish camp, and so
you've got a lot of company now.
So I do have a lot of company now, and I think I'm in good company. But I wouldn't say we're necessarily overly bullish. I think we're balanced, and I don't think that there are very many bears left because of the fundamental pictures. But we have to be cautious of a potential risk as we turn into the calendar year. The president already is sending out social media posts even before he takes office, so we have to take that seriously. There will be increased volatility. I think that's what we need to be mindful of.
Laurie Cavestini was on the program from RBC, someone who I'm sure you know well, talking about the capacity to absorb bad news. Just how stretched are we, and how do you gauge that? What do you look at?
When you look at valuation, yes, it's at the upper echelon, to 22 times forward PE. It doesn't leave much room for error here, right? So that's why I do think that if you do get, a slew of news around tariffs, if you do get these broad-based tariffs implementation, then that is going to add some volatility to the market, and you could see the market trade down. But we also have, corporate earnings season around the same time that the president takes office, and so if we do see, incremental, more positive news on the corporate fundamental side, that could help offset. But absolutely, valuations are on the upper end.
I gave the bull case and a bear case. What's the base case for you and the team?
So our base case is 6,600, and I know you're going to say a lot of people around that, but I would like to point out, Jonathan, that we initiated that in mid-October. Right, so I'm, again, glad to see that others are joining us in the 6,600, but that is our base case driven by 8 to 9% earnings growth.
We've known each other a while. You're preempting me now. Nadia Lovell of UBS. It's good to see you. Thank you. Nadia mentioned some social media posts, so let's get one for you from the President-elect Donald Trump going into bat for his nomination for Defense Secretary and saying this: Pete Hegseth is doing very well. His support is strong and deep. He was a great student, Princeton, Harvard educated with a military state of mind. He will be a fantastic high-energy Secretary of Defense, one who leads with charisma and skill. Pete is a winner, and there is nothing that can be done to change that. Some pushback this morning.
Pushback, and he's saying he's still backing Pete Hegseth to be his defense secretary. Hegseth is really struggling when it comes to these meetings with senators who doesn't look like Jonathan potentially he is going to have the votes. And the conversations I have been having with people that are close to this is that actually there was a conversation with Governor DeSantis and President-elect Trump. And if Pete Hegseth can't make it through, Governor DeSantis is ready to step in.
Watch this space. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Authorities continue to search for the suspect in the shooting of Brian Thompson, the United Healthcare CEO killed in New York earlier this week. Bullet casings found at the scene were inscribed with the words delay and depose. Police say the gunman arrived in Manhattan on November 29th at Port Authority and used a fake New Jersey ID to book a hostel. Thompson's wife told NBC he had received some past threats, potentially related to insurance denials. Meanwhile, the European Union and the South America Mercosur bloc have agreed to a long-sought trade deal. This is despite objections from France, which has vowed to obstruct its ratification. The sides agreeing in principle to a deal that would create a market of 780 consumers while eliminating tariffs on goods like cars and industrial products. France and Poland are the most opposed over concerns over impacts on the agricultural sector. And China implemented new export rules to ban the sale of certain goods to the U.S. for companies not just inside the country, but outside as well. The measure attempts to replicate the reach of U.S. and European sanctions against Chinese products by restricting items that are either Chinese-made or contain Chinese components. Any company or individual that violates the provisions will be, quote, held accountable according to law. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, we'll get you some morning calls. Plus, we'll catch up with Jim Bianco of Bianco Research as we count you down to the November payrolls report. That report drops in 16 minutes' time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Everybody's at 6,600. Got there eventually. So these are the price targets. Most people are actually at 65, the ones I'm looking at. Morgan Stanley, Goldman Sachs, they're at 65. JP Morgan, 6,500. RBC, 6,600. Nadia Lovell, 6,600. Barclays, 6,600. Bank of America, 6,666. BMO, 6,700. Deutsche Bank, 7K. Wells Fargo, 7. 007. Upside is the takeaway here for 2025. Apparently, equity futures right now on the S&P 500 negative by 0.1%. The opening bell an hour and about 13 minutes away. 13 minutes away, we get a jobs report in America. More on that in just a moment. Let's get you some morning calls. First up, Bank of America, double upgrading Dollar General to buy, noting improved inventory positioning and positive customer experiences. That stock is up by more than 2%. Your second call from Jefferies, downgrading Deere to hold, citing potential negative impacts from tariffs in 25. That stock is down by 0.9%. And finally, Citi raising its price target on Lulu to 380, pointing to strong international sales and gross margin. That stock is flying this morning. It's higher by close to 9%. November payrolls just moments away. Economists expecting 220K. And for unemployment to hold steady at 4.1%. Joining us now, Jim Bianco of Bianco Research. Jim, welcome to the program, sir. What are you looking for in about 12 minutes' time?
Probably looking at the October report as much as the November. I'd like to joke that this is the, monthly payrolls report, because we had 47% response rate for October. On the second pass, that usually rises to about 95%. We could actually get more respondents for the October payroll report in this revision than we got in the initial release. And that number could go up a lot, because a lot of those businesses were closed because of the hurricanes, and they've reopened and they've re-reported that they've actually got employees. So not only does November matter, but October matters just as much. And if we get 220,000, say around the payroll, around the estimate, and we get a big upward revision, that's going to put the Fed in a tight spot, because we're only at 68% that they're going to cut rates in the December meeting, and a strong number could push it to 50-50.
Jim, you're a no-lander. You say inflation looks like it bottomed this summer. You think they shouldn't be cutting in December, regardless of what these numbers look like over the next week or so. How big is the gap between you and them at the moment?
Oh, I think it depends, because if you look at the dot chart, they're all over the place right now, the Fed. The one thing that Chairman Powell likes to say is that there's some kind of unanimity or unanimous consensus view. The dot chart says there isn't. There's still, members that think that they need to cut 2 more times this year, and we got 1 meeting left. And there's members that think that they don't need to cut. And if you look at like the long-term dot, they can't agree on where the neutral rate is. It's anywhere between 2.5% and almost 4%. So I think, I'm in the no landing camp. I'm in the camp that the economy is doing fine. I'm in the camp that says, Jay Powell, look at the rise of long-term yields. It is a signal to you that these cuts that we have done is unnecessary. The market is just more worried about that you're creating too much stimulus and potentially an inflation problem. But we'll see. We'll see what winds up happening in 10 minutes and next week with CPI and which way they go.
If we do get a strong number, Jim, is this bond market mispriced then? I know you said yields have been moving higher, but they've actually been moving lower in the past month. We are near the lows of the recent months of this 10-year yield. Is something mispriced with all of the more optimistic estimates out there for what the jobs figure is going to look like today?
No, I think, the bond market moves on more than just a payroll report. It also moves on what's happening in Europe and the weakness there. We've seen some strength in the dollar, potentially a mini flight to quality as the French government collapses in what's happening in South Korea, maybe pushing people into the U.S. Treasury market because it is the reserve currency. But to your original question, I got to say it. Look, if we get a strong number and those probabilities go to 50-50, the Fed has made a terrible mistake, because they're in their quiet period. And now we're going to be back to where we were in September. We're going to be watching the Wall Street Journal reporter, Nick Timiraos, who's the effective Federal Reserve Chairman during the quiet period, and whether or not he gets that call from unknown that says Blue Horseshoe likes 25 or not, and reports it in the paper. And that's how global financial markets are going to be working for the next 10 days on a strong number. It's not what the Fed wanted, but they've created this monster.
Jim, talk to me about how problematic that is for communication of the Federal Reserve. Is that a problem? The named reporter that you name, and it's certainly not his fault, and many journalists envy him of the position he has, but how problematic is that?
It's hugely problematic, because you're right, it is not his fault. The Fed kind of created a system that put him into that position, because now he's got to be careful of the opinions he has. If he writes an opinion piece that this is my opinion, it could be mistaken for that, unknown phone call. and that people will think that this is a policy prescription, and he could be creating policy when that was not his intention all along. So yeah, they've created a huge problem with this. It'd be, if we get a weak number and the probabilities go to 95%, then it's not a problem. But this could be the second time in like 4 months that this is going to happen to the Fed.
Well, Jim, we all remembered before the Fed moved 50 basis points worth of a cut with that Nick Timiraos story, we couldn't figure out whether that was from Fed officials or whether that was his opinion. How much of that, though, leads to a volatile bond market? We've seen that play out time and time again, where the messaging has been strange at times, has been through media, and you get that volatility. What does that mean for 2025 when we're set to get even more volatility because of the different prescriptions we're going to get from fiscal policy?
Oh, I agree. I mean, we're going to get from fiscal policy, we're going to be, everybody's going to get a Truth Social account. And we're also going to be watching the, Nick Timiraos during the quiet periods. And any one of these stories can swing markets one way or the other. And then, like I said, we haven't even thrown in the idea that maybe inflation is ticking up, maybe Europe is weakening, maybe Germany is going into recession. All of this is going to play into a volatile cocktail for the U.S. bond market. And you mentioned also, I should say, that everybody's at 6,600 for their forecasts. I understand those forecasts, but the fly in the ointment of those forecasts could be is everybody agrees that, no, the economy's strong. The Fed doesn't need to cut rates. The offset to all those forecasts are going to be you're going to have to go to 6,600 in the S&P with rapidly rising long-term yields, because that's going to be the natural response to the bond market is yields will go up in response to potentially more inflation and in response to stronger growth. And that could be a drag on a lot of those forecasts.
Jim, I know you're making the point that the data is good. And to John's point yesterday, and I brought up politics, he said the data is good and that potentially is going to help the Fed. But how political will it look if they do not cut in December and they cut twice, or once before an election and once during an election week?
Oh, I think they've already baked their cake with it. That's why that 50 basis point move in September was such a mistake. Because even if they cut in December and refrain in January, and you're right, the data could look good and it could be a perfectly logical reason. But then somebody with a Truth Social account is going to say, you cut rates before the election, and then when I won, you stopped. And that's going to be a difficult thing for them to have to communicate through. But they set this up with that 50 basis point move, 7 weeks before the election. So they made it look political. And if they stop, they make it look political. And if they keep going because they're afraid of the politics of it, they may exacerbate a policy mistake. I'm sorry, they made this bed for themselves. Now they got to lie in it.
Jim, that post was incomplete. The next line reads, and that's why I nominate Kevin Walsh to be the next chairman of the Federal Reserve. Jim, how early are you expecting that change to happen, even if he just makes the nomination and we have to wait for the term to finish?
I know that President-elect Trump is very close with Kevin Walsh. He didn't get Treasury. He didn't get NEC, National Economic Council. I think he's got a plan for him. It's not that, Kevin, I'm sorry, there's nowhere in your position here. And I think that's Federal Reserve Chairman. And if you saw what Scott Bessent, the Treasury Secretary designate, said, that we might have a shadow Fed chairman and nominate him probably this spring or summer. And then everything that the Fed does, you'll have Kevin Walsh on your panel, on your studio during Fed meetings to basically second guess whatever Chairman Powell says at every press conference and at every Federal Reserve meeting. And so this could become another source of, volatility for the market. Well, there's what the chairman says, and then there's what the next chairman thinks. And so we could wind up seeing something along those lines, too.
This could be messy, Jim. Appreciate it, sir. Jim Bianco of Bianco Research on the Federal Reserve and the jobs number, which drops in 4 minutes' time. It is just around the corner. Payrolls, 220K is the estimate. We'll break it down with Mohammed Al-Erin of Queen's College, Cambridge, Tom Porcelli of PGIM, and Jeff Rosenberg of BlackRock. As Danny said all morning, 2 months of jobs data in just 1 day, and it all drops in a few minutes' time.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
December 6th, the last jobs report of 2024 is seconds away. The scores going into it look like this. Equity futures, negative by 1/10%. The NASDAQ, almost totally unchanged. The Russell, positive. Small caps, up by 0.2%. Here's a flavor, a snapshot of the yield curve in America. 2-year, 10-year, 30-year, almost totally unchanged across the curve here. The 2-year yield higher by almost a basis point or two. With your jobs number, here's Mike McKee. Good morning, Mike.
Good morning. Well, we come in sort of in the neighborhood of what the markets were expecting, 227,000. That is a little bit stronger than the 220 that we saw the prior month, that we had for a forecast consensus. Prior month of 12,000. I'm looking right now, and I want to get those numbers for you because we've been revised up in September by 32,000. In October, only by 24,000 to 36,000. So very, very small revisions, which suggests either we're going to get something more. There's been some concern that the strikes maybe not have washed out of the data yet, or we saw a lot of job creation and not much of a rebound from the hurricanes. The unemployment rate, 4.2%. That's up from 4.1%. Got to check and see that on a three-digit rounded rate. The change in manufacturing payrolls, fairly strong, 22,000. That compares with a negative 46,000 the month before, unrevised. Average hourly earnings up 0.4 on the month. Bit of a surprise there, but there was some thought that maybe it's been pushed up by a lack of low-income jobs. And hourly earnings on a year-over-year basis, 4%. Average weekly hours, 34.3, unchanged. And the labor force participation rate drops to 62.5% from 62.6, which does suggest that maybe we saw a larger labor force during the month. So we'll check into that and get back to you in just a moment. I'm sure you're getting some market reaction out of this one.
Yeah, we've got a little bit, Mike, so let's work through it together. So equity futures with a little bit of a pop. Equity futures near session highs on the S&P 500, up by close to 0.1%. Not a big move. If you turn a page and get to the bond market story, this is what it looks like. Yields are lower at the front end of the curve. They were just a little bit higher. We're down by 4 basis points now to 4.1%. Further out along the curve, we're down 2 basis points, the 10-year 4.1510. As you look at that picture, you can get a decent guess of where the dollar is trading, just a bit softer against the euro. Euro dollar back through 106 briefly, so we'll see if this sticks. But Danny, going through the numbers at first look, it's a small upside surprise, but not the major snapback, not the big upside revisions that some people were expecting to the previous few months.
And instead you have an employment rate that does increase. The unemployment rate goes to 4.2%, even though you had a decline in the labor force participation rate that Mike just talked about. So overall, you get status quo from the messaging that we've heard from Fed officials, a labor market that is strong, not too hot. So again, the focus goes to next week. It goes to CPI. This doesn't do anything to shake the Fed off of their course to cut in December.
Mike McKee, I want to come back to you and just ask you about the unemployment rate. Have you seen anything that suggests what's behind that move back up to 4.2%?
Yes, what we're seeing here is the labor force rose by 174,000. That's fairly substantial, but we saw a decline of 355,000 in the number of employed in the household survey. That's a huge decline, and it's kind of inexplicable other than to say these numbers are a kind of volatile on a month-over-month basis in the household survey. So it doesn't quite square with what we're seeing on the establishment side, and I know a lot of people are going to be wondering which one is giving us a better picture of the labor market.
Mike, as you look through some of these revisions, what color do we get around the messy report of October? Does this change our understanding of it at all? Something that was punctuated by strikes and weather effects?
Well, everybody's got to dig into this a lot more, Danny, but I think the immediate takeaway is that the narrative that we saw big strike and hurricane-related drop-off in October, maybe not as correct as we anticipated, and it might have been just a outlier month where a lot of people did not get jobs for one reason or another, whereas the November numbers don't show a big snapback, so it does show some extra strength in the labor market this month. It could also relate to the timing of when companies added temporary workers for the holidays, but that is not clear at the moment.
Mike McKee, thank you, sir. Equity futures positive by about 1/10%. Mike, stay close. I want to cross over to Tom Porcelli of PGIM. Tom joins us now for more. Tom, your first reaction to this one, what jumps out to you?
Yeah, so good to be with you all. Look, I think at the end of the day, this report is pretty consistent with what our view has been, which is to say, the labor backdrop has slowed down quite a bit. I think there are some cracks in the labor backdrop, but the floor is not falling out from beneath us here. I mean, we like to look at something called cyclical hiring, and so basically you just take private jobs, you strip out healthcare. We gained 121,000 jobs this month. I mean, even if we exclude the prior month, which was impacted by all the things that we know at this point, Boeing and the hurricane, you're averaging about 100,000 jobs from a cyclical hiring perspective. So again, our view has been that continued economic expansion will roll into the coming year. But you're going to do it with a labor backdrop that has slowed down, and I think will remain soft.
Tom, just to be clear, does this change anything when it comes to December cuts? The rhetoric we've heard from Fed officials.
No, Danny, I think you're quite right to ask this question. No, I don't think it changes anything. I think at the end of the day, I think this is a kind of number that will support the Fed cutting rates in December. I think that, looking for, 2 or 3 more cuts in the coming year, I think is completely reasonable. But again, I think it's interesting, right? Because people were really looking for, sort of or hopeful that this report will really bounce back in a more notable way than what we've seen, and it didn't. And I think that really drives home that when you look at all this other labor market data, all this other labor data have really slowed down quite a bit. I mean, if you're waiting for the payroll report to crack, it's too late. I mean, this is one of the most lagging of economic indicators, and as I think we all appreciate now, it's revised relentlessly. So I think when we look at some of the leading metrics, it does seem like things are slowing down.
Does that mean that the bigger risk for volatility in this market, for volatility of policy, is next week, CPI, PPI, import prices?
Yeah, Danny, and that's, again, one of the sort of the unfortunate realities, right? I mean, when you think about the things that really drive monetary policy decisions, a lot of them are lagging indicators, like the payroll report, like CPI. So I think you're right. I think that we're probably going to be swung around by some of this data, because while this report at 227 is pretty reasonable, I mean, you can't discount that next month you're going to have a low 1 handle. I mean, that's how the data have been rolling. And then, of course, you then build in the revisions. It's like you're not just looking at the current month anymore. You have to look at what the prior month did from a revisions perspective. So, yeah, I do. I think that things actually wind up being pretty volatile in that regard.
If you weren't just joining us, welcome to the program. You just missed out on the jobs number, 227, a small upside surprise. The median estimate was 220. Unemployment came in at 4.2%. That is the wrong kind of upside surprise. We were looking for 4.1%. Wages coming in just a little bit hotter than expected, in line with the previous month at 0.4%. Joining us now, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, you've had about 7-8 minutes to chew over these numbers. What stands out to you, sir?
Thank you, John. As Jim Bianco pointed out, the challenge for the market and for policy would have been a consistently strong report. This is a somewhat strong report, but not consistently strong. So it is strong on the earnings side. It is strong on the labor participation coming down side, less supply, and it is also strong on a small beat on employment. But the fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening. So on the policy front, this did not complicate what would have been a messy situation for the reasons that Jim pointed out. On the economy side, John, just a confirmation that the labor market remains solid and that U.S. exceptionalism is set to continue.
Mohammed, it makes the decision easy to cut 25, maybe. Still got to wait for CPI next Wednesday. I wonder, though, if it's still just as hard to signal anything for 2025 in the news conference. What is that exercise going to look like in 2 weeks' time?
So it would be hard for this Fed because this Fed is so reactive, is so data dependent, that it will simply tell us that it will remain data dependent. And I suspect that while the range is going to compress a little bit, you're still going to have quite a wide range in terms of the terminal rate. You know, the Fed always has two options. The option it took in 2021 and got completely wrong, which is to look forward, and now it shied away from that and went to the option of being excessively data dependent. And I suspect they'll stay excessively data dependent. So we're not going to get any strong signals other than we will remain data dependent.
Tom, can I get your opinion on this? What it looks like in December, what the summary of economic projections looks like, what they can project forward, if at all?
Yeah, look, I think Mohammed is quite right. I think, you know, prudence, I think, is demanded right now. You know, Powell's he's in a slightly tricky spot. And I think he's laid the groundwork for that, right? Like you think about his speech at the deal book the other day. You know, I think what he laid out there to me, I think made a lot of sort of practical sense. You know, they're just going to continue to wait and see how the data unfold from here. They're not going to pre-commit. I mean, he's already laid the groundwork for, you know, sort of a skip after the December meeting. I mean, he's been pretty clear on that, not just at the deal book meeting, but during the last presser too. So I think, you know, when I think about the sort of the SEP at large, I mean, look, I don't know that they have to make any wholesale changes here. I mean, you know, the economy is more or less evolving in a similar fashion to what they have there for 2025. So again, I think it would be in their best interest to not really make any wholesale changes. This is a nipping and tucking outcome, I think.
Well, when it comes to the data, and we're still waiting on CPI next week, Mohammed, last time you were on for the jobs report, you said inflation is not dead. What kind of number could we see that could potentially change the Fed's thinking at this upcoming meeting?
And you heard from the chair saying that inflation has been more stubborn than he and the Fed expected. Look, we're going to see inflation stuck in the 2.5% to 3% range for the Fed's preferred measure, the core measure. And the Fed is going to have to make a decision. My gut feeling is that it will run with this number there, promising us 2% down the road. And I suspect we'll see 75 basis points of cuts still, but they're going to be spread out. Like you just heard, it's going to be cut, pause, or skip, and then cut. And then we're going to have a huge conversation. Was this a hawkish skip? Was it a dovish skip? So we're gonna go to the third differential now because we lack proper policy guidance.
Mohammed, you went there. So what kind of skip or cut are you expecting? A dovish cut, a hawkish cut? What are you looking for?
Look, no one is going to predict this when you know that the reaction function of the Fed is backward looking, because it will depend on the latest number, unfortunately.
And CPI drops next Wednesday. Bond yields right now are lower by about 4 basis points on a 2-year. On a 10-year, we're down by about 2 basis points. Equity futures still higher on a session on the S&P 500 by close to 0.2%. The numbers dropped about 12 minutes ago. I'm going to cross back over to Mike McKee for a little bit more. Mike, you went through what was behind that uptick in unemployment, the snapback that we didn't really get. I think a lot of people in the market were looking for a big snapback in payrolls. Where did we get some growth and where did we miss out?
Well, what's really interesting is we saw a decline in retail sales hiring, minus 28,000 in the month of November when people are usually staffing up, which leads you to believe that there may be some seasonal effects to this. The seasonal adjustment factors may be holding down the number of jobs created a little bit. Trade and transportation jobs also down 23,000, and that's usually when we're seeing the additional UPS and FedEx drivers and that sort of thing. So a little bit of a surprise highs there. We did see manufacturing rebound with 34,000 jobs, so good news there. Construction only 10,000, and we're looking at the government hiring is one of the highest at 33,000, but almost all that was state and local. Federal government lost 2,000 jobs. And our old friend, leisure and hospitality, did rebound 53,000 jobs total, and about 28,000 of those were in the restaurant business, so people getting jobs there. And then I do want to point out the three-digit unemployment rates, 4.246 for November. So basically just below a 4.3% reading. Would have gotten the Fed's attention, if not worried them. Remember, they forecast in September 4.4% by the end of the year.
Good catch, Mike. As we count you down to the opening bell in about 46 minutes' time, you'll see the outperformance on the small caps. The Russell up by something like 0.8% at the moment. On the screen, up by 0.81 off the back of this move lower at the front end of the yield curve, with yields down something like 4 basis points. Jeff Rosenberg of BlackRock joins us now to get his input on the program. Jeff, welcome to the program. The panel so far suggesting the door is still pretty much wide open for a 25 basis point reduction. Is that your sense of things as well for 2 weeks' time?
Yeah, I think that's the read. This is clearly just reiterating a gradual slowing in the labor markets. As Mike just pointed out, to all three digits, that unemployment rate kind of helps the Fed come in December to cut. The market was already pricing 70% of an outlook for that. And I think the bond market reaction, the initial reaction, is just kind of increasing that on the kind of gradual labor market slowdown. So I think that's very much the read. And as the panel was just discussing, we're going to pivot to this, pause, skip debate and what kind of message that means. But the big debate is over the degree to which cuts have to take place in 2025, and the disconnect between financial conditions, which are going to be easier after today, and the degree of restrictiveness that you still see some of the committee members believe justifies that number of cuts that they're forecasting into 2025.
Jeff, are you arguing then that you need to have a Fed who starts paying attention more to these financial conditions? That conversation has kind of gone by the wayside. Are they going to have to rethink cuts because of what this market is doing?
It's gone by the wayside, but then there was a little bit of acknowledgement of it in Powell kind of acknowledging, yeah, we cut 50 and then the data revised. The whole issue is really about the strength of the economy. And as Mohammed rightly points out, this is a very, very data dependent and reactive Fed. And the data that's key here on how restrictive policy is really economic growth. And you don't see economic growth well below potential. You see economic growth above potential. And that's telling you that monetary policy is not as restrictive as they think it is. Now, there's a little bit of a disconnect between whether you're looking at the growth measures or whether you're looking at the labor market. Take out about 100,000 from today's payroll print. That's hurricane and strike payback. The labor markets are moderating. That's the best evidence of the restrictiveness. But outside of that, you really see the impact on financial conditions, animal spirits. This is a very supportive financial conditions environment, and that's how monetary policy transmits. So maybe you don't need to keep pushing into financial conditions, easing by this degree of cuts that they've been signaling.
Well, Mohammed mentioned it earlier about now the third degree. If the door's open for this cut and there's going to be a bias to 25 basis points, then what is the tone and the rhetoric around that? Is it going to be a hawkish cut because they're going into 2025 and there's going to be a lot of change of fiscal policy in Washington?
Well, it's hawkish in this relative to expectations, right? So 2 weeks ago, 4 weeks ago, the market was expecting, a very aggressive pace of Fed cuts. Now we've priced that out from the markets. And so there's a little bit less of a disconnect between the Fed moderating the pace of cuts into 2025 and market expectations. So that may read hawkish, but if it confirms market expectations, not so problematic. If there's a even greater acknowledgement of that, I think that would be surprising and that would read hawkish. I think when you get into 2025, it is going to be about understanding this pace of cuts has to slow because the economy and the data doesn't support the amount of restrictiveness that the Fed thinks they currently have.
Another round of Fed speak coming up today, and then obviously we're going into the quiet period. I think they've been quite consistent through the week so far. We've mentioned this quote from Governor Waller in a speech from him earlier this week, cut or skip. This is what he had to say on the neutral rate. There is still some distance to go in reducing the policy rate to neutral. Tom Porcelli over at PGIM, I just want to give you a final word just quickly on the neutral rate. They think they're a long way away from neutral. They think they've got space here, which means they can carry on cutting interest rates. How much distance do you think there is between where we are and where neutral might be?
It depends which Fed official you ask, right? I mean, think about the dispersion in the estimates of what neutral is. I mean, the low end is 2.25, and the upper end is 3.75, right, per the long-term dot, obviously nominal we're talking here. That's 150 basis points of spread. So depending who you ask, you could be really far away from it. I think what's going to wind up happening, John, is this. So if you look at the Fed's 25 dot, the median is 3.4%. I think what's going to wind up happening is that's going to shift higher, right? And I think to Jeff's right point, I think it'll wind up shifting higher to where the Fed, where the market is, right? The market is pricing in, I think, 370 right now by the end of the year. So you take out one of those 4 cuts that they have priced in for next year. I think it falls in line with what the market is thinking, and I don't think that has to be terribly disruptive.
Tom Porcelli of PGIM. Tom, appreciate your time, sir. Thank you. Mohammed, I want to come back to you on the same question. I think this is an important debate. How we reconcile our differences here between where the market might believe neutral is and what this Federal Reserve is signaling. How do you think we close that gap?
I think we close it by fudging a very key variable to all this is what is the inflation target. John, if your inflation target is 2%, then you should not cut in December. If your inflation target is somewhere between 2.5 and 3, which is justified by all the changes, all the structural long-term changes going on in the economy, then you cut. And we are fudging this. No one wants to talk about this. I don't know if you saw a few Fridays ago in the afternoon, the Fed put out its discussion of the monetary framework coming up and said explicitly, we will not discuss the inflation target. But critical to all this is what de facto inflation target will they run with. My own gut feeling, as I said, John, they're going to run with slightly higher, and that means that ultimately they'll end up somewhere between 3.75 and 4.
Mohammed, what about the argument that they can't abandon what they have now as their inflation target because it's important in setting expectations? It's important not to have people run away and think that we're going to have higher sustained inflation and therefore change consumer habits. Is there any credence to that argument?
I think there is, and I think there's many ways to do it, and people have come up with different ways. My concern is if they truly believe that 2% is somehow given to them, it's not an arbitrary number, and if they try to get there and stick to that inflation target, they will sacrifice the American exceptionalism. That's what I'm worried about. But Danny, at the end of the day, I think they're going to fudge it by saying 2% down the road, and it's just going to be a very long road.
Jeff, do you agree with Mohammed that 2% down the road is going to be very long?
I do, and I think this is a really important debate, and the Fed has had this debate, and I agree with Mohammed. They're not going to announce a change to the inflation target. They're going to stick to the target, Danny, for the reasons you point out. They agree as well. It's very important to expectations, but there's a lot of room for interpretation, and so 2, 2.5, 2.6, 2.7, and I agree with Mohammed that the cut in December of 25 basis points is kind of telling you where they lean on inflation versus growth. I think there's some long-term consequences for that, because if the bond market wakes up to the fact that there's a tolerance for inflation, and the real test is, as long as inflation is gradually moving lower, and even if it's moving sideways, they can kind of play this fudge it game. The real test is what happens if the acceleration in growth, the impact on financial conditions starts to press on inflation. And the one thing we didn't talk a lot about, and it's hard to see here whether the wage number today and the slight uptick is numbers kind of conforming to, depends on productivity, the 2% inflation target. The real challenge is going to be, what do they do if inflation starts to go back up? Not predicting that, but that's where you kind of are going to put this 2 versus fudging to 2.5 really to task.
That's the risk for 2025. Jeff Rosenberg of BlackRock. Jeff, thank you, sir. If you are just joining us once again, welcome. 227 is the number. It's an upside surprise against a 220 estimate. Unemployment just creeping a little bit higher. 4.2 and very close to 4.3. The estimate was 4.1%. The takeaway for a lot of people in this market, it leaves the door wide open for an interest rate reduction on December 18th. Still one more data point still to go. CPI next Wednesday. Mohamed Al-Erian still with us for some final thoughts. Mohamed, we all noticed that you published the FT column ahead of this conversation this time, and I noticed the content of that piece as well. It's not about whether the US will outperform. It will. It's the extent to which it will diverge from the rest of the world. You noted earlier this week, and I think it's a perfect time just to finish and think about the rest of the global economy. As we get 227 in America and start to complain about whether that's good enough, the rest of the world is struggling. You noted China and a potential Japanification of China's economy. We've noted Europe's inability to govern itself throughout the whole week so far. In a tripolar world, Mohamed, what does 2025 look like?
It's a world of dispersion. John, you know, I've been saying with you for the last few months, the good, the bad, and the ugly of the global economy are to follow. The good is the US, the bad is China, the ugly is Europe. And we've had confirmation of that over the last few weeks. It is a world where there's going to be significant differences in the three systemically important economies. And that's going to play out in the currency market, first and foremost. It also is going to play out in yields, but it will continue to suck capital into the US. And that's the good news for US markets, that if you think of TINA, there is no alternative. There is right now no alternative to American exceptionalism in relative terms.
Mohamed, just to hang on the point of Europe, Robin Brooks of Brookings wrote a column yesterday basically saying Europe desperately needs a weaker euro, and now should be the moment where the ECB decouples from the Fed, where they cut, and they cut aggressively because they need some sort of stimulus that's not coming through governments in Europe. Would you agree with that?
A weaker euro would be like pushing on a string. What Europe needs is fundamental structural reforms. The Draghi report sets out the fundamental problem they have with productivity, with competitiveness. A weaker euro stimulus doesn't address those structural issues. So, Danny, I think it's much deeper than that. And I think that Europe has to understand that unless it takes serious steps, it will fall further behind. Unfortunately, the minute you say further step, you need political leadership, and we know what the situation is like in France. We know what it's like in Germany, and there is no European policy without France and Germany leading right now.
There is very little leadership, that's for sure. Mohamed, we're lucky to get some time with you. Appreciate it. Mohamed Al-Erian there of Queen's College, Cambridge on this Payrolls Friday. Looking ahead to next week already. The ECB's just around the corner, December 12th. Let's get to the week ahead. It looks like this. Before we get to the weekend, we're going into the quiet period for the Federal Reserve, so look out for some comments from Bowman, Goolsby, and Hammack as well. And then as we get further into next week, on Tuesday, OPEC holding its year-end conference. Wednesday, we get some CPI data. Thursday, PPI, and another round of jobless claims. And then that ECB interest rate decision. The guest lineup on Monday looks like this. Neela Richardson of ADP, Chris Harvey of Wells Fargo, Peter Oppenheimer of Goldman, and the IIF president, Tim Adams, from New York City this morning. Good morning to you all. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Futures turn higher after the jobs number beats. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the labor market bounces back from storms and strikes. The U.S. added 227,000 jobs in November, and that beat estimates.
And a view from the White House, BlackRock and PIMCO. We'll get reaction from all of them on the jobs report, as well as Acting Labor Secretary Julie Su, CIO Rick Reeder at PIMCO is going to join us, and at BlackRock's going to join us, and PIMCO economist Tiffany Wilding.
And Trump taps venture capitalist David Sachs as his AI and crypto czar. The pick underscoring, of course, the president-elect's intent to boost two rapidly developing industries. All of that and more coming up. But let's take a look at where markets are trading. As Matt said, 30 minutes until those bells ring. A little bit of green on the screen, a little bit of a lift after those numbers. It seems like the view prevailing right now is that we didn't get anything that is going to change the Fed's course this month when it comes to rate cuts. As such, a little bit of a muted but positive reaction. The S&P 500, the NASDAQ 100, higher a little bit to the tune of 0.1%. Then you take a look at the bond market, a little bit of a rally as it comes to the 10-year Treasury yield, down about 3 basis points. But watch these levels, Matt Miller. We are well below 420 right now, getting closer to 4%.
All right, interesting move in yields for sure. We're looking also at Tesla stocks within striking distance of a record high after losing, remember, 75% of its value in 2021, 2022. But Elon Musk, the world's richest man, has now given more than $270 million. It's won him great influence over the incoming White House. And now his buddy, part of the PayPal mafia, David Sachs, is going to be an advisor as well to Donald Trump.
That's a lot of money. David Sachs had given a lot of money as well. We'll talk about that a little bit more later in the show. Right now, we're going to talk about some stocks moving pre-market. Just Lululemon surging. More than 8%, almost 9% pre-market. There was strength in their international business. They lifted their guidance for the year. Ulta Beauty, another consumer stock, up more than 10% pre-market. Petco also rising higher after positive results. But higher, 23%. You know, I have a dog myself, so you gotta love to see it, Matt.
Yeah, I mean, you'd pay anything probably to keep that dog happy and healthy. The dog might have a job. We added 227,000, and that's better than the expectation. I thought it was interesting coming into this. You know, the whisper number was under the survey, so there was potential for a miss, but I guess after the 12,000 reading we got in the last month, this is welcome relief.
But what was interesting and what I want to ask Julie Sue as well as Mike McKee about was the revision in October. It was pretty small, just 36,000. I think it was expected to be much higher than that when you think about how noisy the last reading was, but not a huge number there, Matt.
Yeah, I think it's interesting also the unemployment rate was higher, labor force participation lower. All in all, a muddy reading, even if they did beat expectations.
Let's get into this muddy reading here. Not as bad as the stormy one we got last month. Mike McKee joins us to give us the details. So we know the headline number's better. The unemployment rate's a little bit worse. How do you see through these numbers to what's really happening?
We're still looking at it through a foggy lens. I'm sure the Fed is trying to figure this out as well because there's some contradictory information in here. We did have 227,000 jobs, which was certainly lower than, higher than anticipated, but payrolls for October we thought would make up a big portion of that, and they don't, with just 36,000 and a revision upward of 24,000. The unemployment rate comes in at 4.2%, but it's to three digits, 4.246. So it was basically just under 4.3%. The average hourly earnings, probably affected by the mix of jobs, doesn't change from last month. And we did see in the month that leisure and hospitality, healthcare, government, the things you would expect to see month after month, added jobs. But the surprise was in retail and trade and transportation. Both of them lost jobs in a month where they're usually hiring a lot. So there's very good possibility out there, I suppose, that we have a seasonal adjustment issue with those numbers. And then you also look at the number of people who joined the labor force. That was up, which would contribute to unemployment. But the number of jobs it created in the household survey was down by 351,000. That's all an explanation for the unemployment rate, but how do we compare the 227 to the 351,000? So some interesting divergences in the data that people are going to be looking at.
You know, this year has been a tough year to read the data. I think that's safe to say at this point, but also the surveys, the difference between the household and the establishment survey, they tell different stories, don't they, about how people are feeling about the job market and where participation is happening.
Well, they do, and they also include different criteria. If you're in the household survey, you don't have to have worked at all. If you're in the establishment survey, you get 1 hour in, and you're counted. But in the household survey, if you didn't work very much, you could say, I wasn't at work. So there may be a distortion there. The biggest issue for everybody, obviously, is what is the Fed going to think of this? And it's strong enough, but not too strong. We've got the weak parts in there that they can justify cutting in December if they want to. So now we move our focus to the jobs numbers. We saw the numbers for the Fed funds futures and for SOFR futures show more of a chance of a rate cut priced in both in December and January. So markets are taking this as a relative positive in the sense that bad news is good news, as it is often for the markets.
All right, Mike McKee, great breakdown. We'll see you in an hour's time. We have some sentiment data coming at the top of the 10, but let's keep the conversation going on what we learned at 8:30, because joining us now is Acting Labor Secretary Julie Sue, live from Washington. Great to have you with us again. Let's start with, of course, the hurricanes and the strikes, because there was a beat when it comes to the headline number, but how much of that was simply a rebound from the jobs that we saw lost as a result of the hurricanes and those strikes?
Yeah, absolutely. That's right. You know, last month we said that the numbers that came out were largely affected by the tragic hurricanes, the fact that there were tens of thousands of workers on strike. Now that we are past that this month, we saw the numbers rebound again. And we often look at averages, so the 3-month average, even including that month of, of relatively low growth because of aberrational factors, is still 173,000. So the picture of this economy, as we've said over and over again, is one of a historic recovery of consistent job growth. And as you all remarked just before this, the unemployment rate remains really low. It not just as an absolute number, but in the face of really record high levels of labor force participation, and those are all signs of an economy that is, not just recovered, but has been consistently strong and stable and continuing to grow.
Yeah, good context there. Of course, we're talking about a slight rise in the unemployment rate, but historically still very low levels. But talk to us about the revisions. This is a puzzle that we were just trying to solve. You had a very small revision to last month's number, just 36,000 jobs revised there for October's number. That came in at just 12,000. The narrative there was, of course, that was going to be noisy when you think about all the different factors, weather, strikes, et cetera. But a small revision, how are you thinking about that?
I mean, I always say this, revisions are really part of the jobs numbers. We report new data when we get it because it's important to be accurate, and it's also important to be timely. So we put out numbers when we have them, we revise them each month. It's also notable that not only were the last 2 months small, they were also upward revisions. So as I always say, the revisions can go up or down. It depends on what data we get. And that's also why we look at averages. You look at the story of this economy from 2022, when it was hot and recovering and everyone said it was going to crash. It did not. It reached a more steady state in 2023, and we've definitely seen that continue in 2024. And I think the takeaway is, this has been an amazingly fast recovery. It's also been really broad-based because we've always said that when you prioritize workers, when you prioritize vulnerable populations, the economy is stronger. It's not just good for those individuals, but also we will be, handing off the strongest economy in history, and those were all not inevitable outcomes.
And while you could appreciate the historically low unemployment rate, the fact that it has been ticking higher, and if you round, you're getting closer and closer to 4.3%, how concerned are you about where the labor market is weakening and how fast it might weaken from there?
Yeah, I mean, it's still, 4.1 to 4.3% since the summer. That is still, as we just said earlier, historically low. It was not anticipated to get that low as quickly as it did. I think, what this also tells you is that economic policies matter, leadership matters, and that is a big part of why we've seen the kind of recovery that we've had. And what comes next is going to depend also in large part on whether there is a continued focus on vulnerable populations, on working people. Again, this is the story of this economy with real wages up, and wages going up while inflation is falling is also not promised, but very much central to the Biden-Harris vision of what makes an economy good, what makes an economy strong. And so, I think hard to say what's to come, but those things, that vision is, I think, a really important part of how we make sure that the economy does well for everybody.
The other strength in the data was with the weekly earnings growth picture, where it registered at about 0.7% higher. And even though it's really the focus is on jobs here, the wage growth, wondering how much that signals to you that there's still persistent underlying inflation under the hood here.
Well, the average wage growth over the year is 4%, right? It translated into more concrete numbers. It's like $4,000 for an individual person working, even after taking into account inflation. So, more money in workers' pockets. I've said that a whole bunch of times because that's also really fundamental to how we think about, all of these things are numbers, but at the end of the day, for working families, for individuals, it's about how you feel when you get home at the end of the day. And that's why our commitment to creating not just a large number of jobs, over 16 million since this administration came into office, but also good quality jobs with workers have a real voice, have a real ability to make a good living, to be able to retire at the end of the career with security, have all been really fundamental too. And so I think when you put up wages against inflation, it's a consistent story too, that we shouldn't have to choose, workers shouldn't have to choose, right, between having a good job where they can afford things and our ability to tackle inflationary pressures. The trend in this economy has also been up on wages and down on inflation.
All right, Secretary, we really appreciate you braving the cold for us. Stay warm out there. That is Acting Labor Secretary Julie Su. Meanwhile, let's take a check on futures right now. Less than 20 minutes until the bells ring. You can see a little bit of a lift in the pre-market. The S&P 500 up about 0.2% if you round up. The NASDAQ 100, a similar story. Where you're seeing real outperformance is the small caps. The Russell 2000 up about 0.8%. Of course, the narrative here is that the Fed is going to proceed with that rate cut in a couple weeks' time. That would absolutely be good news for the little stocks out there. We'll keep an eye on that. And coming up, a great conversation. Rick Reeder, he is BlackRock Chief Investment Officer of Global Fixed Income. We'll get his thoughts on the latest jobs report and what it means for the Fed and for the bond market. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're gonna get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. You take a look at this lift in futures right now. A lift in the bond market, of course. Yields down, price higher. 10-year yields down about 4 basis points. Now, Matt Miller, I know you have a lot to say.
Well, I just, see the 10-year at 4.13, and I note that that's the lowest we've seen in a couple months now. And also the mechanics of it are interesting because we can look at WIRP to justify or to, I guess, evidence the fact that markets expect a cut. But you can look at the bond market pretty easily. So if you think there's going to be a cut, you want to buy the bonds today to get that coupon before it gets lower. And that's exactly what we're seeing, right? Buying those bonds, pushing the yields lower.
Well, anyways, we have the perfect person to talk about that, don't we, Matt?
Yeah, we do. Rick Reeder is here. He works at BlackRock. You may know him as the Chief Investment Officer of Global Fixed Income. He also runs the BINC ETF, BINC, handily beating the benchmark and returning, I think, 5.9%, which is better than a stick in the eye, Rick. Tell me what your response is to the jobs number beating and, the smaller revisions than we expected, the unemployment number. What do you see there?
So I'd say one thing, first of all, I think the market had set up for a pretty strong number after the hurricane-related number before that. So I think there was a little bit of relief from that. I also, when you dig into this number, the unemployment rate, and Mike McKee talked about this, the unemployment rate ticking up, representative of the fact that, gosh, you're seeing some moderate softening in what is a pretty solid labor report, labor market. So a little bit softer when you cut through everything and, you know, expectations that were high. Listen, I think there's some things when you go through it, you look at this leisure and hospitality, it was a pretty good number, so that was solid. But then you go underneath and say, you know, where else? You know, so temporary hiring I thought could bounce back a little bit more after a pretty significant negative the month before. So on balance, with the unemployment rate ticking up a little bit, the Fed can go in December, and then, you know, we got a CPI report that's important, so we got to see that next week. But probably the Fed can go in December, and then, you know, still uncertain how much more they have to go after that.
Rick, you've talked a lot on this program about how you've liked to invest in the belly of the curve, and we get really jazzed here on this program talking about the moves we've seen at the longer end. Are you excited about the longer end? Do you think that there's a possibility or still too much risk there to extend out on duration?
So if you take the grand suite of investments in the world today, so I'm thrilled that you get excited. I get excited about the fixed income markets, but it's also equities are going up over 20%. Like, that's more exciting. So if you said, I could take risk in my portfolio, do I need long end interest rates, which is, you know, obviously a long durated asset, or would I buy equities for my long duration risk? Like, I'll take equities all day with an economy that's growing, an operating leverage machine called the S&P 500. I would take that, and then I just clip loads of yield in the front of the belly of the yield curve. If we can create income, and Matt was kind enough to describe it in our ETF, you know, if you can create income and build 6.5% yield, just buy income. I don't think rates are going very far, certainly in the front end. We'll see how much the Fed can go. And then I just take my risk in the equity market, particularly when equity volatility is so darn low, you can protect your downside that way.
That's a really interesting.
Rates to protect your equity.
Yeah.
Sorry, go ahead.
No, I was just going to say that's an interesting way to look at it from a portfolio construction point of view, that you take your duration risk in the equity market. And it's been a while that you've been preaching, you know, T-bill and chill, just clip your coupons, be happy, don't overthink it. When does that change? What are the ingredients that need to come to fruition for that mindset to shift a little bit?
Yeah, it's a great question. So it's not today, and it's not going to be January. So, you know, we've got to resolve the dynamic of, we got tariffs, maybe a systemic strategic decoupling in the world, and you think about U.S., China, and how do you think through that? Tends to be an inflationary dynamic. You also have the dynamic at play today. You know, we've seen a lot of improvement in inflation. My guess is next year you won't see any more significant improvement, and it probably trends up a little bit more. So I don't think it changes that paradigm unless you believe the economy softens considerably, which I don't think is going to happen. So I think you got a little bit of time. And, you know, I still believe, like you were describing, this idea, stay in the front of belly, clip a lot of yield, use some of the credit markets, securitized markets, clip. By the way, Europe is going to slow. It is slowing faster. You know, get some European fixed income while you're buying U.S. equities. That, to me, is a better expression.
Rick, I guess the Fed in Washington matters less now than what's going on at the Winter White House at Mar-a-Lago. What do you expect from Trump land? What do you expect from the incoming administration especially in terms of tariffs and deportations? Because that's going to have an effect on inflation, and frankly, it's going to have an effect on what we see in terms of deficits as well.
So, you know, it's a hard question. My sense is you have to interpret today that tariffs are going to be the tool of negotiation for this administration, which, as you said, creates some near-term inflationary dynamic. By the way, it also dulls growth. So there's going to be a transmission that we've got to watch pretty carefully. Bit higher inflation, maybe growth trends down alongside that, but then, ironic, you know, and by the way, some cutting of spending, which does dull some of the growth. And then, so we got to keep an eye on that and see how much that takes place. My sense is growth, you know, you look at the U.S. consumer, including the data that we got today, U.S. consumer, you know, when you actually take the income data that comes off of today's data, it's actually pretty good. U.S. consumer's in good shape. CapEx in the country is still in pretty good shape. You got an economy that's moving along pretty well. And my sense is the administration will want to propel that forward while trying to bring the deficits down, cut some spending, keep inflation down, or try to keep it down through things like deregulation, energy dynamics. But, you know, we're going to learn a lot around alongside of that. But listen, I think you can invest in that environment.
Well, you know, you're not the only one who thinks that. We can see from the market that a lot of people agree with you. What about the tariff seems to be our focus, although the mass deportations, and remember the signs at the Republican National Convention, they're serious about deporting millions of workers from this economy on a day when we're focused on the labor market. What does that mean?
So it's a question of how much is going to happen. And so, by the way, if you look at today's job report, and if you look at the jobs report for the last 2 years, 3 years, huge amount of how we filled the labor roles, leisure, hospitality, restaurants, hotels, airlines, was actually through immigration. The transmission, and I'm sure the president and the administration doesn't want to reverse that trend of any significant magnitude while dealing with the illegal immigration. My sense is it's somewhere in the middle, in that you deal with the illegal immigration, but try not to cut off good immigration that flows into things. By the way, also the technology sector, don't cut that off, and make sure the economy's still moving along with, and you know, what grows the economy is if you can grow the labor force, you can grow the amount of wage, aggregate wage, and immigration does that. So my senses are going to try and complete a very fine line of trying to complete that effectively with not slowing the economy down.
I almost want to pinch myself for asking this question, but I am surprised at how much it comes up on this program. This whole idea of government efficiency, Doge. A guest earlier this week pointed out that Dogecoin's market cap was $64 billion nearly. That is more than 3 times the size of the Carlyle Group. And so if you think about the efficiency measures that could be put into place, Rick, are you really convinced that it could make a dent in what we're seeing for the U.S.'s fiscal situation?
So I think making a dent is probably the right dynamic. Are there things that you've got some pretty smart people are going to try and cut spending out? It's not that easy because there are so many entrenched programs that are, quite frankly, politically favorable, and I'm not sure Congress is going to allow for significant slashing there. The only answer to make a big difference in the debt is you got to outgrow it. And so the idea is, like, you want to keep the economy moving. If you can grow nominal GDP at 4.5 to 5 and the cost of the debt stays at 3.5-ish, then you can outrun the debt over time. And to your point, I don't think you can elegantly cut spending enough and without slowing the economy down that you're really going to create that much of an improvement. You got to outgrow it. And by the way, U.S. economy, the amount that's being spent on AI and clean energy and other forms that impact infrastructure, like, that's the only way to do it. That's where you make a big dent.
All right, it's a great point. You can't cut your way to growth. I do want to talk about Bing before we let you go. Of course, it's your fixed income ETF, up about 6.5% on a total return basis year to date. If I take a magnifying glass to your holdings, I see a slight rise in securitized products, a slight rise in your high yield holdings. I also see agency MBS coming down. Is that the market moving things around, or were those conscious decisions?
You're pretty accurate. So those were conscious decisions, and some of that is with the rate volatility. You know, do we need to own as much in the mortgage sector? By the way, still like agency mortgage, still high quality, super liquid. But gosh, I mean, getting yield, you know, I really, kind enough to mention, I just think it's income, particularly in the front of the belly. And, you know, if we can still get 6.5% yield, and, you know, you look at like European high yield, as a dollar investor, you can get 8-ish. Like, getting that income is still pretty attractive. And credit's in great shape. The economy is operating well. They paid down their debt. They termed their maturity walls out. So that was a largely conscious decision, which you were kind of to point out.
Rick, great to have you on the program. Thanks so much for joining us. Rick Reeder there of BlackRock. And, you know, it's so interesting. We have to fight to get Rick on this show.
I know.
Because obviously Surveillance wants him on their show. The ETF wants him.
Yeah, that's true.
Do we still do that interest rate show in the afternoon on Friday?
12 o'clock today. Everybody watch. It's a great show. But, you know, the point he's making about junk bonds, he's not alone. You have junk bonds really headed for its 3rd set of weekly gains. The market piling in right after him.
Well, it certainly helped him beat the ag. Some handy outperformance there. Coming up, it's the opening bell. Don't go anywhere. We'll walk through all the big market moves. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Futures moving slightly higher on this jobs day. We're moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see it's very slight. So S&P futures up only 0.1%. NASDAQ futures as well. Wow, Russell 2000 futures powering higher on hopes that the Fed will cut rates. December 18th is when we get that decision, and of course it would be more beneficial to those smaller cap stocks than the big boys. Albany International ringing the bell at the New York Stock Exchange. Down at the NASDAQ, you've got MMMC. Not really important. What really matters is what's the Fed going to do in the shorter term, and then longer term we have other worries. But in terms of the cash trade, Katie, are we going to see another record today?
Well, we'll see, because yesterday ended up being a little bit ugly for the major averages. At least for right now, you take a look at what's transpired. At least for right now, you take a look at what's transpiring behind me. The S&P 500 building on that early momentum, up about 0.2%. Similar story if you take a look at big tech, the NASDAQ 100. I'm flying through this, though, to get to the Russell 2000 because that is the outperformer today. And Matt, you said it well, that when rates go down, the small caps are supposed to go higher. That is the logic working its way through the market. The Russell 2000 up about 0.7%, just 53 seconds into the trade. Meanwhile, we take a look under the hood because earnings season, it's still here. And Lululemon is surging after the activewear brand lifted its full-year net revenue guidance. Analysts also highlighting strength in their international business. And this stock needed it because through yesterday's close, it was down 32%, Shanali, currently up about 12%.
I'm watching another retailer here because if jobs are generally strong, so are retailers. Wages strong too. Ulta now up almost 10%. Good day for retail, kind of across the board, isn't it? Shares are jumping of Ulta after the beauty retailer reported better than expected results. It also raised its full year outlook. Matt, people are buying makeup.
Yeah, not me, but I'm glad, I guess. I don't know if I'm glad.
Are you wearing makeup, though?
I don't wear makeup
You're
typically.
supposed to.
I know. Let's not tell anybody, otherwise the boss is going to be like, you have to. It's HD, right? So you can see every pore. Petco also positive after results beat analyst estimates. Morgan Stanley said there are signs of stabilization in that business, and it's mostly because of Loki. Let's get a closer look at the broader market right now as stocks rise following the jobs report. For that, we go over to Abigail Doolittle.
Well, stocks not just rising after the jobs report, Matt, but we
We also have a weekly gain. In fact, over the last few weeks, we've mainly had gains for stocks. Let's take a look at the NASDAQ 100 over this time period. Up a very healthy almost 8% since the presidential election. In fact, today, B of A's Michael Hartnett saying that stocks and Bitcoin, well, they might get a little frothy in 2025, that stocks could go higher from here, but there's reason to think that there could be some kind of a pullback in the new year. If we take a look at valuation for the S&P 500, we will see Michael Hartnett's point. This is price to book, and you can see right now well above 5, the peak a little bit higher back during the tech bubble, a healthy price to book where you would really want to buy a stock less than 1. So you can see, again, very overvalued. In addition, you can see this massive rally higher, 2 legs of it, pretty parabolic. Parabolic uptrends do tend to consolidate in some way or form, and you can see that happened out of the pandemic rally into 2022. So perhaps Michael Hartnett will prove correct about some sort of cooling off in 2025 for a period of time. As for Bitcoin, well, of course, over the last 2 days, it's been a wild ride. More than $10,000 worth of intraday volatility on Bitcoin as it went back above 100. You can see, though, over the last month, out of the election, the Trump trade, the idea of pro-America, up more than 31%. And, of course, his administration expected to be friendly to Bitcoin, and the related ETFs and stocks, well, they are really on a tear.
Really on a tear. You just can't escape crypto. Abigail Doolittle, thank you so much. Let's keep the conversation going now with Gabriela Santos. She is JP Morgan Asset Management Chief Market Strategist for the Americas. Great to see you in person.
Great to see you. Thanks for having me again.
So we get these economic data releases, the jobs report at 8:30, then we contort ourselves to figure out what the Fed is going to do. And with that in mind, I love this first line in your notes. Don't miss the forest for the trees. It's all about fiscal policy, not now monetary policy. Tell me about that.
That's right. I think we've been used to, over the last 15 years, really, to focus a lot on what's going on with the Fed, what's going on with monetary policy globally. I think what the Fed is telling us is we're pretty close to the end of this adjustment period lower with rates. And now it's really about fiscal policy and governments really telling us that they're going to keep these very elevated deficits, very high debt issuance. And so the attention for us next year is really what's going to happen with the 10-year. You could make arguments for it to stay in a pretty wide range between 4%, 5%, maybe testing that 5% ceiling from last year. And really, a lot of attention is going to be paid on the evolution of the tax bill next year. Baked in that the $4 trillion in expiring tax provisions will be extended. The conversation really is additional tax cuts, where there's the potential for $3.5 trillion more.
I feel very vindicated because I wake up in the morning and I make Matt look at the 10-year. And for a while there, he's like, yeah. But you look at it now and you have people thinking it could get as low as 3.5%. I didn't hear that in your calculation here. Do people have it wrong?
They're a little hopeful, right?
Super hopeful.
I have a hard time seeing it get to 3.5%, honestly below 4% on a sustainable basis until we get the eventual next recession. Part of it is for good reason, higher nominal growth. We've seen an improvement in productivity. There is a certain amount of inflation back. But part of it is related to this persistent elevated deficit as far as the eye can see, actually potentially above 7% if all the expiring provisions are extended. And additionally, if we get those additional tax cuts. And I think this is true globally. We're seeing what happens in France. We're seeing what happens in the UK. So the US is not immune to there being a certain premium that investors demand for lending for such a long time to the government.
Even without COVID spending, Donald Trump added far more to the deficit in his first term than even, big spending Biden did. Can we expect the same, you think, in the next Trump administration? And do the bond vigilantes ever come back in force?
This is truly a bipartisan issue, right? And I think part of it is because of how hard it really is to cut government spending. About 80% is just entitlements, defense spending, interest spending, and that's only going to go up from here.
Well, do you have any faith that Elon Musk and Vivek Ramaswamy are going to be able to reduce the the budget by $2 trillion?
I think it's a worthwhile effort. We just have to moderate expectations about how difficult that is. Non-defense discretionary spending is only 13%. It's hard to squeeze some juice there without making tough decisions around entitlements. And then in terms of revenue raising, there's the discussion about tariffs. Tariffs represent only 1% of government revenue. So we really have to 1,000x the tariff revenue here for it to make a dent, really. And we're talking about additional tax cuts. That was going to be true regardless of the outcome of the election. That's why bond yields have stayed persistently above 4%. Now the discussion is additional tax cuts. For example, exempting tips or overtime income or cutting corporate taxes additionally.
Well, let's bring this conversation to the stock market because we talk about all these different cross currents, what it could mean for the long end of the Treasury curve. You're right that for asset classes across the board, it's the long end that you need to pay attention to. So how does this filter through to the equity market?
I think for equities, it's all about, as it has been this year, why the 10-year is moving higher. So especially over the month of October, it really was moving higher for good reason. Resilient data, the job scare from the summer had passed. Things are looking all right. It's just a normalizing, pretty good labor market and economy. I think what we have to watch next year to see if this starts becoming a hurdle or potentially a catalyst for a correction in equities is if the 10-year starts moving higher, much more about this fiscal concern, or if it starts moving higher because of inflationary concerns again. So unfortunately, I thought we were done with inflation. I think next year we have to watch that again, and specifically inflation expectations, which have moved higher by 60 basis points since mid-September.
Looking at fiscal policy, looking at the long end, is it fair to say that Gabby's research is driving our conversations with every guest today?
Yeah, it really is. And you know, the other part of this too, we were speaking to Rick Reeder at BlackRock just a little bit ago, and he mentioned growth concerns. And if you're concerned about growth, then what does that spillover look like into the equity market, particularly if you're one of the investors that believes that a lot of the growth this year was really kind of at least backstopped, if not propelled by government spending?
So I think in terms of growth, there's a nuance. What we've been seeing in the economy, in consumer spending, in the job market, in cyclical sectors like manufacturing and housing, is normalization. By normalization, though, we do imply a certain downshift in the pace of growth from the 3% we've been seeing this year towards a 2-handle, a 2% next year. And then there is some optimism about certain elements of economic policy, lifting of animal spirits we've started to see, but there are also countervailing aspects of economic policy, like an increase in trade policy uncertainty. So for next year, we're penciling in about 2% growth. As you get that deceleration, you might have moments of correction in the market. But overall, I don't want to leave the bearish impression here. We still think there's opportunity in risk and equities and corporate credit. It's just that I think you have to work harder to really get that access to that pretty decent growth story, especially with valuations, as you were mentioning, where they are now.
Well, that's a great note to leave it on. It's great to see you again. Come back soon. That is Gabriela Santos of JP Morgan Asset Management. Now, coming up, the Retail Roundup. We'll take a deep dive into results from Lululemon, Ulta, and Petco. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on stocks. Green across the board right now. The S&P 500 up about 0.3%. Big tech making a run for it, gaining some momentum here, up 0.4%. But your leader so far in the U.S. trading day is your small caps. The Russell 2000 up about 0.7%. The expectation is that the Fed is going to cut rates this month. It's helping the little guys. We'll continue to keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Bank of America is upgrading Molson Coors to a buy. The firm says that 2025 will be more normal now that the company and the wider beer industry has moved past the Bud Light controversy. Next up, Peloton gaining some traction. UBS quadrupling its price target on the fitness company, also raising its recommendation on the stock, saying that it's no longer a sell. The analyst highlights additional cost cuts that will help boost its outlook, and Peloton now only has one sell rating on the street. And finally, Jefferies is downgrading Deere, saying it's no longer a buy. The firm cites valuation concerns for the company and says that the ag sector may be at risk from possible China tariffs. Matt?
All right, interesting rundown. Let's take a look at some more individual stock stories. There were earnings out last night in the retail sector that I think many people here on set found fascinating. Lululemon is boosting its outlook on strong sales overseas. It's a sign the upscale activewear brand is successfully navigating slower growth in consumer spending. Joining us for more is Bloomberg's Bailey Lipschultz. Not a customer.
Not a customer.
Come on. They have a men's section.
I'm cheap, though. So I'm like a discount. I've worn the same pair of soccer sweats since high school.
Well, as we learned yesterday, you're flying back and forth between the coasts.
I'm spending all my money on United flights, so I'm keeping them in business. And
we know what we're going to buy for Christmas presents.
Wait, you guys are getting Bailey Lululemon pants for
I was
Christmas?
going to buy it for you, but I can't keep it secret.
Yeah.
Anyway, Lululemon, some international strength.
International strength. Stock up at 1.18%. That was the biggest intraday jump since 2016. We were talking about it yesterday, Scarlett and I. U.S. sales ended up being flat on the third quarter, but the big growth, 39% jump in China. So when you're trying to tease out what companies are going to be better positioned for the move forward, clearly seems like Lululemon is tapping Asia, which I don't think many analysts really had on their bingo card.
It's amazing they're still doing so badly over the last year, right? And year to date. So
It
down.
kind of reminds
China's
me of
volatile, too. It's the issue.
Peloton. Like, you have such a brand name in Peloton and Lululemon, and then you take a look at the stock price and you say, uh-oh. So
you've got to wonder if there's a correlation also. Well, the other thing too is Ulta. You know, you wonder after this earnings season what you can draw in terms of conclusions on how the customer is behaving. People are buying makeup, but Ulta's still down on the year.
Yeah, the big thing with Ulta is competition. So you have the partnership between Sephora and Kohl's. You have people who are shopping online, buying goods from Amazon. In the report, they did increase their annual projections for comp sales and earnings better than Wall Street was looking for. But to your point, still down almost 10% in the last 12 months. Biggest jump right now, 14% since 2020. When you look at how consumers are spending money, especially here in the U.S., and how they're trying to either cut costs or kind of like the K-shaped recovery where people who can't afford to spend are spending, Ulta kind of falls in that interesting spot to keep an eye on.
Yeah, absolutely. Real bellwether it's turned into for the beauty names. Billy, we're going to ask you about Petco, and then we're going to talk to Shonali about it. But Petco soaring as much as 28%. It reported earnings. That's a big jump. But then you take a look over the past year to date, it's up like 83%. So
you got to keep in mind, about 30% of the shares are sold short. When you look at the past earnings reports going
30% of the shares are sold short?
Okay, see, I didn't want to yell about it, but yeah. So this is a short squeeze. When you look at past quarter movement, last time jumped 22%. Quarter before, 33% gain. Quarter before that, 18% gain. You go back a year, 29% drop, 21% drop, 18% drop. It's a meme stock. Like, it's a name that people know. It's heavily shorted. You're trying to tease out whether consumers are going to go to stores and be able to afford it. But Shonali, not everyone shops at Petco. Like, you're not a Petco user.
But you don't even, what's the Lululemon of Petco?
The Foggy Dog.
Okay.
I've never even heard of that.
Oh, it's so good. But you know what? My dream would be like pet brand consolidation, right? Like the discounts on Petco of Foggy Dog. Oh, like, you know, now you have me. But, you know, that's a long time out. Bailey, thank you so much for joining us here on set. That is Bloomberg's Bailey Lipschultz. A lot going on in the retail world, but we're going to move to politicals. We are going to talk about President-elect Trump next, adding venture capitalist David Sachs to his cabinet. We're going to take a look at the impact of that in today's Wall Street Beat. This is Bloomberg.
To the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
It's time now for the Wall Street Beat. Today we are looking at San Francisco and Donald Trump's decision to go all in with David Sachs. He selected the venture capitalist to serve as his artificial intelligence and crypto czar. I correct, it is not a cabinet position here, but it is a spot that will put him very close to a lot of decision making. Here with more is Bloomberg Technology co-host Caroline Hyde. And this post itself had a lot of eyes on it because of the crypto role, because of the importance and rulemaking around the future of AI, particularly Gen AI. But even before all of that, how did David Sachs get here? I mean, he donated a lot to the Trump campaign, but he has to both political parties. How did he get here?
Yeah, he's an issue-based
voter, ultimately, is what he'd say. But he has recently very much aligned and come out saying and he's in support of Trump, largely because of the economy. In fact, go on to his X page. He's an investor in X. He's a big investor in Elon Musk more broadly. And of course, he was part of the PayPal mafia. But he's written his whole thesis on why he was backing Trump, whether it be about the economy, the border, about foreign relations, in particular Ukraine and Russia. But he is someone who's on the All-In pod become closer and closer to many people who ran for office, whether it be Ron DeSantis, whether it be Vivek Ramaswamy, and then eventually going all in on Trump. But this is the role that everyone was looking at in terms of AI and crypto. And this man, no matter what your political beliefs, you've got to hand it to the guy. He makes incredibly sound venture backs. He backed Meta at an angel round. You're looking at Palantir, he backed at an angel round. He's been in some of the most successful exits that you have ever seen come out of Silicon Valley. He's built a $1.2 billion exit company himself, Yammer. And when you just look at the who's who of Craft VC, which he currently has, this man knows his understanding of crypto. They're in Lightning networks, they're in Bitwise, BitGo, and in an awful lot of AI companies. In fact, he joined the show 6 months ago to talk about Glue AI, which is an AI backing of his. And I think we can just bring you some sound of what his view is on artificial intelligence.
There's innovation happening at every level of the stack. I mean, you're seeing tremendous innovation at the foundation model layer. You've got OpenAI, you've got Anthropic, like you've mentioned, you've got AI now launching that we just invested in. Then you've got innovation happening at the application layer of the stack, where applications are able to take advantage of all the new capabilities created by these LLMs. And if you're positioned correctly in the application layer, you don't want to compete against the models. You want to harness them so that as the models get better and better, your application gets better and better.
He's going to have less time to build Glue AI, obviously, because he's going to be spending up to 130 days advising the government.
Yeah, interesting to hear him talk about XAI. And for those who haven't listened to All In Pod, I just want to say it's fascinating to see how they've gone from the world of technology. They've really broadened out to your point, the nation's affairs in a massive way.
To the nation.
The nation
And
affairs.
poker. Healthy obsession with poker, too.
Yes, yes.
Poker. I thought you said hoka for a second. I looked at Katie.
Running shoes?
So you said 130 days. That's the most that he can work, I think, officially for the government without having to divest his interests. He's going to stay on at Kraft, right?
Yeah.
He
He's a
is
key man
allowed
risk.
to continue his investments in crypto as he advises the White House on crypto, right? So are there any conflicts of interest here?
I mean, there might well be, and he's going to have to recuse himself if they do come about. Look,
He's supposed to, right?
He's supposed
when you
to.
say he's going to
And
have
look,
to, who gets to judge that?
Well, we will, hopefully, and we'll understand. They're going to bring an air of transparency. That's what everyone has been focusing in on. And look, we'll have to question the same for Vivek Ramaswamy, who himself is also an investor. And when you have to look at Elon Musk himself, many are going to have to recuse themselves, but many would argue that those that are close to the frontier of business building, that understand how difficult regulatory situations are, and indeed how many layers of regulatory tick boxes you have to go through in construction, for example. That's some of the companies that David Sachs backs. Maybe they are the ones to ask. But yeah, it's going to be a very difficult tightrope to walk to ensure that people don't think that they're basically backing themselves, backing their own investments.
No one would think that, right?
Who would be that cynical?
You don't think that Elon Musk spent $274 million to buy influence in order to boost his business interests, do you?
Are you a professional Elon hater? Because
No.
that is what David
No.
Sachs is calling a lot of mainstream media. It must be said that if you listen to the All In Pod, you do know some of the reticence and issues that David Sachs and a lot of those on All In Pod have with mainstream media, and indeed what they say about Elon Musk in particular.
All right, Caroline, great roundup, of course. A really interesting appointment here. That is Bloomberg Technologies' Caroline Hyde. She's on right after this show at 11 a.m. But don't go anywhere, because coming up in the next hour, we'll speak to the CEO of Janus Henderson on 3 macro drivers investors must navigate in the year ahead. Plus, an exclusive interview with the CEO of Ducati. Matt Miller, I know you're excited for that.
I'm very pumped. Claudia Domenicali is going to come on after Ducati has won its 3rd world championship in a row in MotoGP. And we'll find out if win on Sunday, sell on Monday actually is true in the luxury motorcycle business. This is Bloomberg.
general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Well, when I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
showing strength in the labor market, and that strength can sometimes translate into inflation remaining higher for longer.
The Fed meets in 2 weeks. CBS News has learned President Biden is considering pardoning select Trump rivals to spare them possible prosecution in the future. CBS's Nancy Cordes.
We're told that names of individuals have not necessarily been discussed specifically with President Biden, but they have debated whether this would be a good idea with him.
It may be true. Still, the UK's Royal Mint is honoring Paul McCartney with money in a special collector's edition. One coin will feature King Charles on one side and the Beatles legend on the other. This is CBS News. Love. A famous Parisian cathedral makes a comeback this weekend.
5 years ago, I stood here watching Notre Dame Cathedral burn. Now, this emblem of the French nation is once again reopening to worshipers and tourists. It only took the work of close to 1,000 laborers, both on-site and in artisanal workshops across France. And it's finishing on time and under budget. Vicki Barker, CBS News at Notre Dame Cathedral in Paris.
A nun has been arrested in Italy in a mafia raid. Reuters reporting Sister Anna Donelli, a volunteer at a prison in Milan, is among 25 people suspected of collusion. She is accused of acting as a go-between for the mafia and jailed members. Other suspects are accused of things like vote buying, illegal weapons possession, and drug dealing. In February, 57-year-old Sister Anna was awarded Milan's Golden Panettone for her work. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. Alex Steele and Paul Sweeney here. This is a Bloomberg Intelligence firm. We got some economic data coming out here this morning. We had the non-farm payrolls came in a little bit better than expected. Good news there. Wages are going higher. And just now crossing the tape, University of Michigan sentiment data, Alex, coming in a little bit better than expected. 74 was the reading. The expectations was 73.2. Last month was 78.1. Let's break down those numbers right now with the source. Joanne Shu joins us, Surveys of Consumers Director for the University of Michigan. She joins us. Joanne, it seems like on the surface, some pretty good data. How are you interpreting it?
So while we saw an improvement in sentiment, this isn't actually coming from a place of strength. Most of the improvement came from buying conditions for durables, which really surged this month. But when you dig in a little bit deeper and we look at the follow-up questions to this, what we're seeing is that a lot of consumers are expecting prices to spike and increase next year, particularly with tariffs. And that's why they think it's a good time to buy now, not because they necessarily think the economy is headed for a strong trajectory.
Oh, wow. And that's an inflation wage price spiral. That's what we've been worried about for so long. What about the labor market? What was the sentiment there?
Consumers aren't really seeing a whole lot of changes in terms of labor markets. Right now, we're kind of in a recalibration phase where people are trying to update their understanding of the economy based on where economic policy is going in the year ahead. So by and large, Republicans expect labor markets to strengthen, Democrats expect labor markets to weaken, and independents, they're still trying to figure things out. They're not really reporting much of a change from last month.
So, Joanne, the University of Michigan expectations came in at 71.6. The expectation, the consensus was 77.7. Why was it weaker? What does that data point reflect?
This reflects, again, this post-election recalibration of different people in the population. So with expectations, Republicans, they immediately improve their expectations because they believe that the president-elect's policies are going to usher in low inflation and economic growth. Democrats, on the other hand, are very worried about the trajectory of the economy under these new, under what is likely to be a new policy regime. In particular, they're very, very worried about tariffs, and they're very worried about where inflation is going to be going in the year and the 5 years ahead.
All right, Joanne, super appreciate it. Thank you for all that instant analysis. Joanne Shu, University of Michigan Surveys of Consumer Director, joining us. And again, as Paul was pointing out, the future sentiment for UMich actually turning lower, even though the actual number for right now increased a little bit. All right, let's get you caught up now on a business flash. There's tons of stories happening within the market here. And for that, here's John Tucker.
There are?
Yes.
Oh, okay.
Lululemon, HPE's at a record high. The S&P
Bloomberg
is at its 57th record this year.
Okay, I was wondering what it was. This Bloomberg Business Flash being brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast. Get started today. Yeah, another record. S&P 500 on track for that. 22 points higher. 6,097 on the index. Traders boosting bets on a December Federal Reserve rate cut after the latest jobs report. Payroll growth rebounding for the month of November. The advance of 227,000 supports the Fed's view that the labor market is pretty solid. Yet 8 of the 11 major industry groups in the S&P 500, they're up right now, being led by consumer discretionary. And year to date, Alex and Paul, the S&P 500, 28% higher. But Lori Calvasina at RBC Capital Markets says, you know what, investors are feeling kind of nervous right now.
I will tell you that as I've been talking to investors over the past few days, there is concern about frothiness in the markets, where valuations are, where sentiment and positioning are. So I think we have to keep that in mind.
Lululemon Athletica, you mentioned it, Alex. Nora's going to do it a little more in depth. Edging up its full year outlook, strong overseas sales. Lululemon shares right now 18% higher. I like to buy the knockoffs at Target.
You and me both.
Yeah.
Okay.
So we check the markets for you.
You buy yoga pants?
No. I wasn't going to ask, but I was curious.
What are you saying? I don't look like I'm into yoga?
No, because you I don't want to go there. Right.
Maybe a relative. Maybe for a relative.
I'm not gonna. Okay. We're gonna leave that for off cam here. All right, John. Thanks a lot, John Tucker, Alex Steele, alongside Paul Sweeney. Norma Melinda's here as well. Bloomberg Equities reporter. She's gonna break down some of the big movers of the morning. Okay, let's kick it off with Lululemon.
Yeah, I mean, I feel like everyone has to stretch apparently, or we should be.
Not for $80 a pan, I don't.
And I agree with you. I've only bought one pair of leggings from Lululemon back in maybe 2015. Have never been back, but people apparently do kind of sort of still shop there. So we're seeing the stock has fallen 21% this year, but today we're seeing that shares are up as much as 18%. That's the biggest intraday gain that we've seen for the company since 2016. And this is after it raised its full year outlook. It said that it was seeing some strong sales overseas, despite some slowing growth that we've been seeing in terms of some of the retail names and just the consumers here in the United States. The CEO actually said that he's hoping to branch out into some baggier styles, and they're hoping that this will actually get people coming back into the doors and shopping.
Are there Lululemon stores?
Yes, there are. There are brick and mortar
Okay.
stores, at least in Virginia. I don't know. Do we have some up here?
Yeah, they're
okay.
here.
But I'm curious if the baggy styles are going to work. I mean, I feel like everything at Lululemon is so tight, so hopefully this will provide some relief.
Well, it's because skinny jeans are out and wide leg pants are in.
That
so
is
they're
true.
trying to like capture some of that trend.
The trends always come back.
That's right. I should have kept those
Bell
from the
bottoms.
90s. I used to have bodysuits and blazers in the 90s. They're back. So there you go. Ulta Beauty though, different story.
Different story here, but we are still seeing shares higher. They're seeing their best best day since November of 2020. They're surging on strong sales despite some fears from a lot of analysts who are nervous that they are discounting too much ahead of the holidays. I mean, of course, as a consumer, I'm like, why are we complaining? But I understand on the other end here. But when we're looking at the company, they're down 10% this year, especially, of course, as you're thinking about the consumer trying to decide, do I go to Walmart, Target, go to these stores to get the low-end makeup, or am I going to ball out at Ulta or maybe a Sephora? So something to keep an eye on here.
So Sephora is considered what end?
I view it as luxury, but maybe I'm just cheap. I prefer Ulta when it comes to saving a buck.
I mean, I think for me, like going to a department store to the counters is like super luxury,
for sure.
fancy stuff. But then Sephora is right under there. They sell the same products, and like it never ever goes on sale. And let me tell you, you go out there and there is a line at least 20 minutes long every single time.
Because John, you know what you have to do? You have to invest in your face, John.
There it is.
You missed that somewhere.
Yeah, skincare. It doesn't have to be makeup.
My daughter's brought me into these places, and I'm just like, I cannot wait to get out of there.
Yeah.
The margins on that stuff is just
gotta be awesome.
Yeah, I mean, but that's where department stores make their money. It's in the cosmetics in the first floor, basically, at the end of the day. All right, before I let you go, HPE or record high?
Yeah, record high, soaring for an all-time intraday high. We're seeing these shares up as much as 10%. And on a year-to-date scale, they've jumped 37% this year. It reported quarterly revenue that increased, and it also saw a jump in its server unit sales. Of course, we know that HPE is more focused on business computing, data centers, whereas HPQ is the PCs, printing market situation.
All right, Nora, thank you so much. We appreciate it. Nora Melinda giving us the latest on what's happening in the markets. Again, a lot of economic data popping out today, leading off this morning at 8:30. Change in non-farm payrolls came in at better than expected, 227,000 versus a consensus of 220,000. The revision from the last month was from 12,000 to 36,000, so some good numbers there. Tom Gibble joins us. We always love to check in with Tom on Jobs Day. Tom is the founder and board member of LaSalle Network, one of the leading staffing and recruiting firms in the country. Tom, pretty solid number. What'd you take away from the non-farm payroll data?
Well, number one, I'm not wearing any Sephora or Lululemon at the moment, so I don't know what that means.
Thanks for clarifying.
Yeah, want to make sure we're clear on that. But no, you guys know when we're putting up over 200,000 jobs, you know how I respond, that things are great, and we've got to look at that as a very strong positive. Average hourly wages up a little bit, average hours worked up a little bit. Revisions were not bad. That's a good thing. Like, everything is pointing positively. I really hope that the Fed does not lower interest rates. I don't think we need it. I think it's something we're going to need the dry powder in the latter part of next year, and to make sure that we realize this economy is going really strong. And with unemployment inching up, that's exactly what everybody's been saying. We need to curb inflation.
So the counter to that is the household survey being a lot weaker. What did you make of that?
Listen, I think that if we're looking for areas of weakness, this is why economists have jobs. They're always going to find some number that goes against the grain of what everything else says. My feeling is what we know is factual. More people are working. Unemployment historically at 4.2 is still very, very low. And unemployment is going to go up. Why is it going to go up? Because of Doge. Is when we do that, when Musk and Vivek get in there and we shed government employees, they are going to file for unemployment, and they don't automatically convert to the private sector. And so we're going to have a situation where I believe unemployment is going to go up naturally, and we're going to need to be able to have that lever to pull of lowering interest rates, and we don't want to use it now.
Average hourly earnings on a year-over-year basis up 4%, a little bit better than the expectation. What's the wage environment?
Hold on. I mean, look, think about that for a second. If somebody gets a 3% raise as a cost of living increase, a cost of living adjustment, COLA, we say that that's what corporate America does all the time. We're talking about 4% average hourly earnings year over year. That's a third better than what average increases are in corporate America. I think those are really good numbers.
Inflationary for you, or is this just, again, a healthy labor market?
No, I think it's a little bit of inflationary, but we're looking at, what we still have. We all go to restaurants. We see that there isn't enough workers, and even though that's where so much of the hiring was done this past month, and going into the holiday season, you're going to have more of that. There's a lot of positive feelings, whether you like the results of the election or not, that it's anti-regulation and it's really pro-business. And so companies are going to be hiring and wages are going to go up because in order to get people for the jobs that are in demand, i.e. service jobs, or to get people to leave in white-collar jobs, you're going to have to pay more, and it's going to increase that dollar amount. But I think, I want to repeat, when we get more federal workers who are filing for unemployment, that number's going to go up, and you'll see the inflation come down naturally.
Yeah, that's such a good point that we forget that's coming at some point over the next few years. Thanks so much, Tom. Really appreciate it. Tom Gimbel, founder and board member of LaSalle Network. What was also interesting, Paul, is that the retail hiring wasn't that great, which was interesting headed into the holiday season. And I wonder if we're learning anything on that, like if that's a consumer read-through or that's really a one-off.
Yeah, exactly. We'll see. But again, pretty solid labor market any way you look at it.
Yeah, pretty much. And that's why we're seeing sort of a record high within the S&P. You're 57th so far for this year. Coming up, Jeffrey Cleveland, chief economist at Payton & Regal, will be joining us for his outlook on the economy.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Right now, you have 7 of the 11 major industry groups in the S&P 500 higher. The index on track for another record close. And this year's surge for the S&P 500 is approaching 30%. You did earlier today get the payrolls report, non-farm payrolls increasing 227,000, following an upwardly revised 36,000 gain in October at Principal Asset Management. Seema Shah says a December cut pretty much in the offing right now, but early next year, she says the Fed is likely to slow its cutting pace to every other meeting. Among the economic data, also had consumer sentiment rising to a number around 74. That actually is the highest since April. The year-ahead inflation expectations increasing to 2.9%, and that actually is a 5-month high at this point. As we look at the major indexes, the S&P 500 is up 22%. That is up 0.4% at 6,097. The Dow Jones Industrial Average 82 points higher. That is up 0.2% right now. And the Nasdaq 100 up 164 points. That's a rise of 0.8%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, we got some breaking news for you. TikTok is officially facing a ban in the United States. This comes after the appeals court refuses to block the law that would ban TikTok. Now, the whole idea is to force a sale of TikTok here in the U.S. from ByteDance to an owner in the United States. Whether or not that happens is definitely a big question mark. Lots of question marks around this. First of all, will Trump stand by this, or will he oppose the ban and then complicate its enforcement? If it was to spin off, and if someone were to buy it, who would that be? What would the numbers look like? But either way, you take a look at Google and Meta. Meta, arguably one of the competitors, right? Because they have Instagram. That stock up over 2% on that headline, Paul.
Yeah, this is big news in the world of social media, digital advertising. Meta again up 2.2% today at the 52-week high. But boy, TikTok has become so big so quickly in terms of number of users, their total audience, and the advertising they generate, and the retail e-commerce that they generate, just in a handful of years, become absolutely huge. Now what did they do? Now what does ByteDance do? The owner, again, the Chinese owner of TikTok, and again, what does President-elect Trump do, as you were talking about earlier? I'm not sure really his real position on this.
So just for some background here, the law was signed back in April. It did have bipartisan support, and it was to force a divestiture from ByteDance of TikTok here in the U.S. Now, then, of course, there were lots of lawsuits, etc. Now, leading American investors like Sequoia Capital, General Atlantic, and Susquehanna own significant stake in TikTok's parent company, ByteDance, and that's collectively worth billions of dollars. So that also then complicates the issue with President Trump-elect in office as well. Now, ByteDance was trying to get it overturned, saying banning the app is unconstitutional. So let's get more here with Matthew Schettenhelm. He covers this he's a media litigation analyst for Bloomberg Intelligence. All right, are you surprised?
I am not surprised. This is what we expected coming out of the September oral argument. It was a tough hearing for TikTok. What we haven't seen yet, and it just popped up on the docket, is the opinion, the reasoning from the court. And it looks like there's a concurring opinion from at least one judge, but I haven't been able to read the decision yet. But this looks like a loss for TikTok. That's what we expected, and that means that if it wants to stop this ban before January 19th, its only realistic option, I think, is probably going to be to go to the Supreme Court now and try to ask the justices at the Supreme Court to hit pause on that January 19th date.
And what typically how would the Supreme Court respond to that type of request typically, given this ruling here?
Yeah, so I mean, you go on what's known as the shadow docket at the Supreme Court, where the court looks at emergency relief, and the thing is, it's hard to get that. You usually need 5 justices to vote in support of it, and so there's a risk. And again, I want to read this decision, but there's a risk, I think, for TikTok that the justices say, look, the D.C. Circuit got it right. We don't really need to get in the way of this. On the other hand, this is potentially a major First Amendment question, and maybe the justices say, look, this is so important, let's hit pause on that January 19th date so we can take it up, and then they'd probably decide it by June of this year if they're so inclined.
Okay, so let's pretend that we move forward to January 19th, right? And that's the date where it would be banned. So if my kid's on TikTok, which she's not, like, does she automatically can't get on it? But if she goes to like Mexico, she can access TikTok? Like, is that what I'm looking at?
Yeah, so yeah, on January 19th, the way the law works is it doesn't strip it off of everyone's phones on that date. The way the law works, it says that as of that date, any company that carries the app in its app store or that carries TikTok on servers in a way that allows the app to update no longer can do so. If they do so, they're at the risk of gigantic penalties. It's something like $5,000 per user. And so if the DOJ is willing to enforce it, which is going to be another question, President Trump, potentially could tell his DOJ, look, don't worry about enforcing that law. But if you're a company that carries TikTok in your app store, are you going to take a chance that President Trump is not going to enforce something that could reach billions of dollars in liability against you? I'm not so sure.
What do we know about President-elect Trump and his administration, how they're viewing this particular issue? Have they opined on this yet?
Yeah, well, so Trump's been back and forth on this issue. So President Trump was the first one to propose a TikTok ban, and his administration moved ahead with one, and then fell in trouble in court because he tried to do it himself without Congress. Then this time Congress did it and passed it. President Biden signed it, but then Trump reversed himself, and now Trump has said publicly, look, we don't want to help Meta. I don't support a TikTok ban anymore. The problem is it's already law. It's already done, and I think it's a difficult thing for him to convince Congress, which passed this on a bipartisan basis, to reverse itself. And so his only options would be kind of the unusual course. Oh, we're not going to enforce a law that Congress just passed, or or approving some sort of sale, a divestiture. But there's no indication that China would allow that sort of a divestiture.
All right, really great stuff. Really appreciate it. Thank you so very much for jumping on with us. Matthew Schettenhelm, media litigation analyst for Bloomberg Intelligence. And then, of course, like, TikTok is a really big customer of Oracle. What does that mean for Oracle? Like,
I see what
Meta has Instagram. Is that good for Meta, etc.? So going down that rabbit hole as well. All right, let's get back to the economic data of the morning. That, if I dare say, Goldilocks job report. Jeffrey Cleveland is chief economist over at Payton and Regal, and he joins us now, as he does every Jobs Friday. Hey, Jeffrey, is this a Goldilocks report? Like, can I say that, or is there another word I can use to describe this?
Yeah, Goldilocks, soft landing. I think both of those phrases work. You've got decent headline job growth. The 3-month average, I think, was 190,000. Sorry, the 12-month average was 190,000. The 3-month average is around 180,000. So that's enough, I think, to keep downward pressure on the unemployment rate. So that's good. There's probably enough concern about the unemployment rate ticking up, like it did in the report, to 4.2. So from a risk management perspective, I think the Fed, keeps on cutting. So we get a cut in December, but there's no evidence of a recession here. So you've got, a continued economic growth, no recession, and a Fed that is going to continue to cut rates over the next 12 months. So I think that's Goldilocks. That's great for risk assets.
Great for risk assets. That's kind of where I was going to go, Jeffrey. I'm just wondering how you think our Federal Reserve is going to view this data here this morning before their December 18th meeting.
Well, I mean, they're tasked by Congress with keeping us at full employment, Paul, right? So, they want to keep that unemployment rate low. They don't want to risk that it continues to tick up. So I think that's top of mind. The only thing preventing them from focusing on the labor market was inflation. But I think inflation is cool. The pay, if I could give a pitch for the Payden and Regal chart of the week out this morning,
I guess.
You know, we looked at market-based core PCE, and that looks bang on with the Fed's target. You know, it's running at about 0.2% month to month for the last 4 or 5 months. So that's good enough. Inflation is back to target. So focus on the labor. So I think that keeps the Fed cutting, Paul, at the December meeting. We can debate about how much they really need to cut next year.
Yeah.
They could probably afford to go more slowly, sure, but cutting they will.
So, Jeffrey, here's the counter. So Tom Gimbel, we just talked to him, founder and board member of LaSalle Network, was talking about the fact that once the DOGE office, so the Department of Government Efficiencies, just slashes government workers, all those people are not going to be going to the private sector necessarily, so the unemployment rate will rise. And the Fed's going to need a lot more dry powder to combat that, which means that maybe they don't need to hike anymore right now. Cut anymore right now. What do you make of that argument?
Well, I think from the Fed, a central banker perspective, they're going to say, well, we're going to wait until we see the actual details of any plan to slash spending or cut payrolls. So until we see that, we have more definitive details, that's not going to alter the Fed's plan. The Fed is going to look at what's going on with their trajectory for growth, the unemployment rate right now, and the inflation, and then make decisions based on that. My only thing on this DOGE thing is that a lot of the government employees are at the state and local level, not as many at the federal level. So I wonder how much you could really slash and burn there. So that might not. I think once people get into office, they might realize the details. Reality is not quite what they thought it was, and they might be more difficult to make cuts. However motivated they are to make cuts. So I think that's an issue here. We'll have to see how this plays out. TBD.
TBD. Jeffrey, so we get this pretty solid labor number here. How do you view the U.S. consumer? It seems like the U.S. consumer, if he or she wants a job, he or she has it, and wages are going higher, pretty decent.
Yeah, I mean, average hourly earnings ticked up, Paul. You saw that, so that's good. So for us, Payden and Regal view on consumer is look at income growth. If the consumer in aggregate continues to have income growth, sure, there's always pockets of weaknesses, but overall, aggregate income growth is still humming along at 5% year on year. When you account for, what people are being paid and how much they're working, how many people are working, that looks excellent to us. That's the reason why, Paul, in the last 8 quarters, U.S. GDP has continued to be 2 to 3%. Consumer spending has continued to pump along, and it's because of income growth. So I don't see anything in this report that alters our view on that. So that's one of the reasons why we remain bullish on the U.S. economy.
All right, so you think the Fed's going to cut then in December. This is all fine enough to do that. Then what, as you raised?
I think, the argument that central bankers would make is that as you get closer to neutral, where you think you'll kind of settle in, that you can slow down. So as you approach the intersection, if you will, Alex, you take your foot off the gas a little there in your car, you slow down, right? Yeah. Some people just power through. I don't know. But I think that's what they'll do. So, right now we have penciled in 4 cuts next year, so 1 per quarter. I think that's a decent starting point at this juncture. And as you know, we've been talking for a while now, I've been hawkish most of the last 3 years. I'm, more worried about inflation. So I think this is a sign of Payden, being nimble, not being dogmatic. If the facts have changed, inflation has cooled. So the Fed will be cutting over the next 12 months.
Jeffrey, thank you so much for joining us. Always appreciate getting a few minutes of your time, particularly on these jobs days. Jeffrey Cleveland, he's the chief economist at Payden & Regal. He's out there in L.A. joining us via Zoom here. Again, the jobless claims numbers coming in a little bit better than expected. Wages moving a little bit higher. Generally a pretty solid, very solid labor market. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The S&P 500 pushing higher, on track for its 57th record close this year. Fed speak over the past few weeks suggests openness to another rate cut for this upcoming December meeting. And today's jobs report, you had the rise in the unemployment rate, may only support that push. After today's jobs report, Jeff Rosenberg of BlackRock training his focus now on the Fed's inflation fight. And some of the other news we had today, TikTok's Chinese parent company facing a ban in the U.S. if it doesn't meet a January 19th deadline to sell the video sharing app. Federal appeals court ruling today upheld the new U.S. law enacted to protect national security and user privacy. Among the TikTok competitors, I'm going to say YouTube and Snapchat. Snap shares right now.
And Instagram, no?
The
Did we not get
Instagram.
Instagram?
Remember who you're talking to. Anyway, Snap shares.
Hey, you have Lululemon pants apparently.
Up
So
2.6% right now. S&P 500 overall 21 points higher, and that is up 0.4%, 6,096 on the index. The Dow Jones Industrial Average up 31 points at 44,794. The Nasdaq 100 right now up 163 points. That is up 0.75%. Yields are lower. The more policy reactive 2-year yield, that is down about 6 basis points at 4.08%. The 10-year, that is down 2 basis points. That's at 4.15. And the VIX, that is lower right now, 1310. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
all right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries worldwide. So here was the news of the day for me. It crossed right at like 4:15 yesterday afternoon. Chevron is slowing its Permian growth plan. So that stock is down by about 2.5%. It's going to reduce CapEx there by up to 10% in 2025. They're going to prioritize free cash flow over production growth. In some ways, that scenario is no surprise, but the why behind it I found to be a little interesting. Vincent Piazza, Bloomberg Intelligence Senior Equity Research Analyst for Oil and Gas, joins us now. Vincent, I was interested in your take. Do we think it's price motivated because the oil price here in the U.S. under 70? Demand, because Chinese demand just hasn't been holding up, so we're just in a surplus market? Or do you feel like it's about reallocating money elsewhere?
Well, look, I think it's about where the industry is right now. You're not being rewarded for growth. You are being rewarded for discipline. You're being rewarded for controlled production growth, controlled spending discipline, and you're being rewarded for generating free cash flow to provide incremental financial flexibility. Look, the upstream group that I cover is roughly trading at a free cash flow yield in the 7% range. What is being rewarded is modest production growth, in addition to increases in base and supplemental dividends, with a little bit of share buybacks involved. But that financial flexibility does provide you with the opportunity set to consolidate a sector with a uncertain background. Look, OPEC Plus is continuing to keep those barrels off the market. So that tells you a lot about where the demand is. Overall here in the U.S., production growth has been pretty anemic. We're running roughly about 13 million barrels a day. That's a little bit above where we were last year. In 2025 on our numbers, we'll likely grow a couple of 100,000 barrels. So there is a factor of uncertainty with respect to demand. Correct, WTI is roughly down about 6% this year. So there is a degree of uncertainty, but the industry is programmed to sort of throttle that production growth, and the industry is being rewarded for free cash flow more so than drilling for growth.
All right, here's a problem I have with Chevron on the Bloomberg terminal. The DES function, which is the most widely used function, describes any ticker you put in the Bloomberg terminal. It says Chevron It describes the security of the company. Chevron Corporation operates as a renewable fuel company. That's not correct. They're an oil and gas company that is evolving, like everybody else, to a certain degree to clean energy. I watch Landman. I know what's going on out there in the energy business.
Yeah, you do. Yeah, you do.
Hey, Vince.
To be fair, they have a hydrogen project.
They have a hydrogen project.
They do carbon capture.
I'm all down with the independent oil producer these days. All right, so, but if oil were $100, Vince, would this vaunted, discipline, would that go out the window like it usually does?
Hey, look, you can't grow 15% every year from the Permian. At some point, that needs to be throttled back. And I think that's what the key is. Look, the industry is roughly 3% of the S&P 500. It hasn't really moved much in the last few years, and that's with a spike in oil price a few years ago, and that's with a decline in oil price too. So this isn't about the volatility of oil price or where oil prices are. It's about the longer term trend for this industry. This industry will remain challenged because of civic pressure, because of cultural backlash against legacy hydrocarbons. It's managing its way through. And how do you manage through that process when you are a mature industry? You consolidate. There's going to be fewer but larger energy companies. Look at Diamondback. Look at several other companies. Exxon has been out in front of the consolidation phase in the Permian as well. Both of these companies are growing in the Permian. It's just not as stout as it once was because it doesn't need to.
So Vince, I guess my question then is, why is the stock down? Because if they're prioritizing free cash flow in order to also protect their dividend and buybacks and all of that, why isn't the market rewarding them for that?
Well, WTI is down 6% overall this year. It's down 2% today. So my entire screen is red today, and it's been red consistently this year because of the volatility in WTI. So it is about where we are on the demand side. Balances are going to be judged by the growth in demand, and right now it's a clouded backdrop. It's quite uncertain. This isn't the commodity super cycle of the early noughts.
Yeah, no, it's not. Which also then begs the question, do you think that if they're in that prioritizing free cash flow place, how do you think that these kind of guys think about allocating capital to other stuff? Like hydrogen, like carbon capture, like renewable fuels, that was very much ramping up to be a part of their budget. What do you think where do you think they are now?
I think the priority will be legacy upstream. And that was included in their disclosure that a largest portion of the organic capital investment is going toward upstream. The biggest component of that upstream regionally is going to be the domestic marketplace, whether it's onshore or offshore. So I think that tells you where they see the greatest return on their investment dollar going forward.
Well, and then to that point, if we go to best return on their dollar and then efficiency, how much more efficiency do you think these big guys like Exxon, Chevron, Conoco can really wring out of the Permian? So
ExxonMobil is integrating Pioneer. There are definitely efficiencies that can be digested there. Of course, we have to keep in mind with Chevron, it has arbitration with Exxon with respect to the Hess acquisition. So that is an outlier there. So that will likely be resolved in one way or another in the first half of 2025. Conoco has the Marathon deal that they're going to digest. And so there are efficiencies that can be gained. Keep in mind that what tends to happen with these M&A is that once you acquire the entity, you're ratcheting down that growth to suck out that free cash flow too. You are modulating that growth, and that's what helps free cash flow.
All right, Vince, appreciate that. Thanks very much. Vincent Piazza joining us, Bloomberg Intelligence Senior Equity Research Analyst for oil and gas. All right, coming up, George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We haven't talked to him in a while, so something must be happening today with Boeing. Boeing, a plea deal over a fatal 737 crash was rejected by a judge. We'll get the latest. This is Bloomberg Intelligence. Happy Friday.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. Good friends at Boeing back in the news. A U.S. district judge rejected Boeing's proposed guilty plea to fraud charges related to 2 fatal 737 MAX crashes. It was a surprise to me. I'm not really sure it was a surprise to the market. I don't know. The stock's up 0.5% here today, but it's taken its on the chin this year, down about 40% is Boeing as they try to get past a lot of these issues here and ramp up production of the MAX 737 MAX. George Ferguson joins us here. He covers all the aerospace companies, all the airline companies. He's got it covered soup to nuts here. George, it was a surprise to me, but I don't follow this stuff day to day. What's going on with Boeing and potentially resolving some of these crash issues?
Yeah, this looks very procedural, right? So as I've seen the reporting on this, there's an issue about DEI requirements for some of the oversight on this, for this settlement, and so it looks like that's largely why this was rejected, and so I don't know that we can read a lot into whether this means Boeing could get another similar type settlement and, put it past them and with the same sort of requirements. So I think you saw the stock didn't do much on it yesterday. I think the market's trying to figure out, again, it's very procedural DEI issues. The market was thinking, what do we do with this?
So now what? Now what does Boeing do?
Well, I mean, this kind of litigation takes a long time. And so I just, I don't think it's a big issue to the company. I think they'd like to resolve things and put it behind them. But I think it just means the court throws it out and starts again, I guess, or something like that. I mean, you probably have to get Jen Reed, a legal analyst, on it.
Yeah, okay, fair enough. What? You're not a legal analyst too? Just the airlines?
No, I'm not ascribing. I'm not. This is not. This is not a big stone in the road that's going to interrupt Boeing's recovery here. I think this is fixing the vestiges of the past.
So where are we, George, in kind of ramping up production at Boeing 737? Give us some numbers, kind of where they are, maybe production right now, where you think they'll be maybe in a year from now. Where do they need to get to? Because that's really key to the cash flow story here.
I'm glad you asked that question. On Monday, we plan to publish our expectations for 2025 deliveries. And the sneak preview is we think Boeing deliveries will be up some 45% next year. 38 is sort of this, it's a number I think that gets used a lot because that's where the FAA gave Boeing the right to go to. It's a number I think we were driving at, this year as the recovery was going on. We think they'll achieve that 38 rate sometime in 4Q next year. We kind of see this slow ramp up. That's on the 737. We see a slow ramp up, for the 737. I think Ortberg will try to keep things, going with a lot of quality, in the process, a lot of oversight in the process. And so I think it doesn't mean there's a huge snap back to production rates at 38. I think, like I said, they get there at the end of the year, but it will still be a nice increase because, Boeing won't have to struggle through a strike like they did this year. We're hoping there's no problems like a door coming off like we had the beginning of this year. And so they can start to get the factory humming, start to get a cadence into it. And again, that would probably be a 45% increase in total Boeing deliveries, as well as 45% for the 737 MAX, we think.
All right. Before we let you go, I did want to get your take on airlines in general, because American Air and Southwest yesterday, they had some pretty good read-throughs, which I have to say was surprising to me, because that's not the rhetoric we're used to hearing out of airlines, and especially Southwest, for example. Do you think we've troughed, the worst is over here?
So look, we're seeing some capacity come out of the market, and we're seeing others adjust capacity growth down. And so we've started to see some of the U.S. airlines report that yields, price paid per mile flown, are a little bit better than they originally guided for 4Q. You know, that's not unusual for airlines to guide a little bit lower. I do think it's a positive sign. You know, like we thought fuel prices might be a nice tailwind for the airlines. We'll see how that develops, right? They've been sort of sub 80 here for a while. You know, oil's been sub 80 for a while. That would be a nice place to put it. That would give them the opportunity to maybe discount a little bit more, fill airplanes a bit, and improve profits. So I think we're kind of seeing, you know, we've seen fares sort of falling off. I think we're kind of seeing a little bit of an arrest of that slide here, which could give you slightly better profits. That's kind of where I think they're at for even into 2025. American saw a really big day yesterday. If you look at their stock price movement, I think it was 18% when I last looked at it. That was a bit different. They just cut a new credit card deal. I think it was with Citibank, if I recall correctly. And they talked about the growth in revenue from that credit card deal growing 10% per year. And I think it's the last 12 months, they said it's something like $5.6 billion. And they said something like when it got to $10 billion in revenue per year, they saw 1.5 billion of that flowing down to pre-tax income, which is a really strong contribution to profit.
All right, George.
I mean, those.
Yep, we're going to leave it there, George. We got to head up on the break here. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst with Bloomberg Intelligence, joining us via Zoom here, talking about Boeing, and that stock is up about 0.5% here. S&P 500 up 221 points. That's 0.3%. The Nasdaq up 129 points. That's 0.6%. So we got some green on the screen here on the back of some of these jobs numbers and economic data.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you. We're going to dissect all the market moves and the job reaction. Amy Glazer is Senior Vice President at Adecco on the November jobs report. Plus, it's Friday. It's Munis in Focus. Martin Braun is a Bloomberg Municipal Finance reporter, will be joining us. Plus Nathan Dean, Bloomberg Intelligence Senior Policy Analyst on all the recent Trump appointees when it comes to crypto, when it comes to AI. Plus Lisa Nee is Managing Partner and Head of Real Estate over at Eisner Amper, joining us on the latest in the commercial real estate market. But let's kick it all off for you right now with the Bloomberg Business Flash. And for that, we go to John Tucker.
You sound just way too cheery.
I bring it, man. This is my job.
Okay. Whatever. S&P 500 on track for its 57th record high so far this year. And since the start of the year, the S&P 500 right now up just about 28%. You mentioned the data. Non-farm payrolls increasing 227,000 last month. The jobs report increasing bets on a December Federal Reserve rate cut, so stock investors welcome that. Reacting to the jobs report, economist Claudia Saab at New Century Advisors earlier today said she sees, nothing to get too excited about here.
And really, it looks like we're kind of back where we were before hurricane. So it seems to be giving a pretty consistent story of the slowing, but nothing real shocking here.
Meta owns Instagram. Those shares right now, Meta shares, they are up 2.1%. Shares of Snap, they're up 1.3%. This comes after a 3-judge panel in Washington upheld that new U.S. law that bans TikTok's Chinese parent company if it doesn't sell TikTok. The New York Post, I just want to bring you this update, is reporting that DNA evidence has now been recovered from United Healthcare CEO Brian Thompson's killer's water bottle that they found, and the bullet and the bullet casing. So they may be closer to a break in this manhunt for the killer in the tri-state area here in New York City. S&P 500 right now 21 points higher. That's up 0.4%, 6,096. The Dow Jones Industrial Average 58 points higher. That's up 0.1%. The Nasdaq 100 is up 155 points, and that is a rise of 0.7%. Two-year yield 4 basis points lower at 4.10. The 10-year yield right now pretty much unchanged, and that's at 4.17. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so head out to youtube.com and search Bloomberg Podcast, and that's where you'll find us. As John Tucker was just reporting, pretty big news out there in the social media world. TikTok faces U.S. ban after appeals court refuses to block the law. Let's check in with Michael Shepard, Bloomberg News. He's the senior editor down in Washington. Michael, this seems pretty... I don't know, cut and dried right here. Was this a surprise? What's the view here about this ruling from this D.C. circuit?
Well, it wasn't so much a surprise, even if it does feel a little bit like a shock just seeing it, that we're moving a step closer to actual enforcement and enactment of this ban on the app as soon as next month. The arguments that the company had made during the hearings in September before the three-judge panel here in Washington did not go as well for the company. Even during the presentation of the case, the questioning from the judges indicated some skepticism, and we saw that reflected in today's unanimous ruling from the three judges on the D.C. Court of Appeals. They rejected TikTok's claim that the new divestiture ban law would violate its users' free speech rights and also harm small businesses. Instead, the court found that what the government had done in enacting this law was actually intended to protect free speech rights that it saw as potentially being harmed by Chinese-related ownership of the app.
So based on that, the question really becomes about enforcement. If this goes forward, do we know what President Trump's President Trump-elect is his final view on this is?
We don't yet, and that's a great question, Alex, and it really is the one that's hanging over all of these proceedings. The law actually snaps into effect the day before Trump is to be inaugurated, and we also have the prospect of a Supreme Court challenge by the company that we would expect really any moment from now on until the ban actually is to take effect. And they may try to seek an emergency ruling, but our colleague, Bloomberg analyst Matt Schettelheim, does not think that the Supreme Court, that is, would act on an emergency basis to rule on the law's constitutionality or to halt it. They may decide to take it and put a stay on its enforcement, but delay deliberation on it until later in the year. That would leave some time for Trump to decide what to do and how to enforce it. It is a law, though. He can't simply ignore it. And we would have to see, would he try to maybe get a narrow Republican majority Congress to reverse the measure that was signed by Biden in April. What we also could see, interestingly, is the presence of two of his key advisors, Marco Rubio and Mike Waltz, reversing this position by Trump against the ban.
What have we heard, if anything, from ByteDance recently? What if this ban does in fact go in effect? Would they abide by a shutdown? Would they look to divest it? What have we heard from ByteDance?
Well, what we have heard consistently from them is opposition to this law and a refusal to sell. And in their initial court filing in May, they even said, look, the sale is impossible. They see it as physically and technically unworkable because the technology of ByteDance is so interwoven into the TikTok platform that it's really hard to separate the two. They have not said what they will do if they finally reach the end game. Okay, now you have to shut down. The U.S. would have to explore whether it would go after people who try to access TikTok via a VPN as opposed to other platforms. Mm-hmm. And, that is where, as Alex brought up earlier, the enforcement questions start to crop up.
Let's walk it forward and say, for some miracle, ByteDance is like, fine, okay, I'll divest it. Who's going to buy it?
Well, that is another really big question.
I'm 2 for 0, man. I'm
you really are. And it would take somebody with deep pockets. You know, this app is worth tens of billions of dollars. It has 170 million users in the U.S. It's a lucrative advertising market potentially and sales market. They've recently increased their efforts to use the platform as a way to sell goods and become kind of a third-party retailer in a way. That makes it appealing as an acquisition. The few entities out there that have deep enough pockets to do that, say some of the big tech companies like Amazon or Microsoft, they would face some difficulties potentially on the antitrust front. So you would then have to think about what are the private equity and private funds out there that could pursue this. Steven Mnuchin, the former U.S. Treasury Secretary under Donald Trump's first term, he had floated some idea about exploring a purchase of the app, but we haven't heard much more about that. And I don't know that anybody is willing to come forward yet again until we actually have a resolution in this case.
So again, are there next steps that you and others are, and we should all be paying attention to, or do we just wait to hear to see if they go to the Supreme Court?
Yeah, Paul, really that is the key next step right now is when they go to the Supreme Court, how they might rework their filing and reframe their appeal to the High Court to see if it might gain more purchase there than it did with the lower court today.
All right, thanks a lot. We really appreciate it. Thanks for jumping on with us, Michael Shepard, Bloomberg senior editor over in Washington. All right, the other big news of the day, of course, is what happened with the job market. Just to recap here, November added about 227,000 jobs in November. That was definitely payback from disruptions due to hurricane and weather, as well as Boeing's strike. You also saw revisions higher as well. The one little blip was that retail hiring disappointed. Many are saying that could be because of seasonal factors, because the holiday season is a bit shorter this year than normal. So compared to other seasons, it looked a little bit more disappointing.
Do you remember what was #1 on my Christmas list?
Lululemon pants?
No, actually, the 22-ounce framing hammer.
You never told me that.
Oh, okay.
And you need Lululemon pants to go with that?
That's a vision.
TBD. Isn't it, though? So the market's taking it as Goldilocks, so we wanted to get more on this with Amy Glazer, Senior Vice President at Attico, joining us. Okay, what's your take? Give us your broad strokes here.
So I think this was definitely a best case scenario. Healthcare continues to lead the way. Gains in leisure, hospitality, we're seeing that through the holiday surge. Warehousing, transportation picked up as expected. Overall, a really great report.
So where do you see, are there any headwinds out there for the labor front? Because again, this is, at least by my reckoning, a stronger, it just maybe stronger than expected kind of labor market out there. We hear about the K-shaped economy all the time, but boy, it seems like everybody who wants a job has a job. What are you looking at under the, under the hood there?
Yeah, there's still more than one job available, 1.11 jobs for every applicant. So jobs are out there. The question is, does it mirror and match the skills of the applicant? But we're seeing gains on the East Coast. We had a really great quarter, and I think it'll continue.
Where do you see the
flexibility is what's key here right now? So part-time jobs, we will continue to see increases, especially with holiday hiring. Employers have a greater appetite than ever for anybody who's looking for a second job or part-time flex hours.
Are you hearing anything about government workers and what will happen with DOGE, with the Department of Government Efficiency, and sort of concerns or worries there? Is that percolating at all in your world?
No rumblings yet.
So what do you make of that? That people feel confident it either won't happen or they can easily switch jobs? Like, what's your takeaway from that?
I think they're just kind of in a wait and see type of mentality. I think one of the interesting notes we saw for the first time is really this increase in wages. So for the past couple of months, we've been saying, wage pressures are cooling, and we're starting to see an uptick of that again. So it'll be interesting to see if that continues leading into the new year.
Amy, this is troubling. My notes say that you are in Ponte Vedra Beach, Florida. Is that correct?
Yes, correct.
Yeah, and Paul, I'm waiting for.
Well, I mean, there's a golf course there that is like world famous, and I'm kind of just a little bit jealous.
He's probably
there.
seeing the flags behind me.
Yeah, I don't know. Everybody's and it's a little chilly here in New York. That's why I bring it up. Sorry about that.
Oh, I see.
Amy,
it's your birthday, so you can do that.
Yeah, I can do pretty much anything today. Amy, talk to us about the wage environment out there. I mean, it seems like wages are pretty darn solid ahead of inflation. It seems, again, the folks that have jobs, it looks like they're getting some decent wage growth.
We're seeing that literally over the past 2 to 3 weeks. We've started to hear about wage increases, specifically in the blue collar space, which has been pretty stale over the last year. And I think it's going to continue for the upcoming months.
So you have had tons of experience spanning staffing, management, business operations. Adecco is, helps the global workforce solutions, right? So it's a provider to help people staff. If I'm an employer and I'm looking to grow or ramp up, particularly in 2025, if I get tax cuts from President Trump, if sort of deregulation takes hold, what kind of sectors do you think are you hearing that will be the case for?
Well, I think any employer that is going to provide flexible opportunities is going to be the winner coming up. We still have, stay-at-home moms that would like to re-enter the workforce. Flexibility is key, whether it be in hours or in a hybrid work situation or work from home. And I think that trend will continue.
Amy, how about getting back to work? Where is the new world order? What are you hearing from your corporate clients as they think about 2025? Any changes to getting back to work policies? It looks like we've heard Elon Musk say he's going to ask or make federal employees come back, 5 days a week. We're hearing Amazon and some other big companies say the same thing. Is that going to change anything going forward, or is this the new normal?
I think it's the new normal. We will continue to see hybrid be successful in many cases, but I think we're at steady state now, new normal.
All right, Amy, thank you so much. We appreciate it. Amy Glazer, Senior Vice President at Adecco, joining us from Ponte Vedra Beach, Florida. Great. It's like the World Golf Hall of Fame, and they've got a great golf course down there where they have the Players' Championship every year with the Island Green. So if the golfing people out there know exactly what I'm talking about, you not so much. Okay.
Not so much. My dad was a big golfer, but
I
just never wasn't my thing.
Wasn't your thing?
He shot under 80 for a while.
Wow.
And I hear that's something, right?
That is something.
78, 79. I feel like that's just something kind of situation.
That's very rare for me, particularly these days. But again, I think on the labor market, I mean, if you're the Fed, you're seeing a solid labor market, and I could see them cutting rates, but I can also see them saying, okay, we've done enough here. We've done 100 basis points. We're going to sit back and just kind of see how the data comes in.
What I find really interesting too, if we pair that with the University of Michigan sentiment, and yes, it's the preliminary read for December, but just to recap that number, current sentiment's at 74, so that was kind of in line. Current conditions 77, that was much better than estimated, but future expectations 71.6, and that was lower than estimated. And if you read between those tea leaves, it's a question really of people buying now, like say durable goods, because they're worried those prices will go up if tariffs increase, and then inflation expectations also rising for the future because you're worried about higher prices. So it's sort of an interesting spot. The job market still good. There are question marks though, but how do you price in a question mark if you're an investor?
And I think post-election, the feeling out there just feels better. Maybe it's just because we've got the uncertainty of the election behind us, number one. Number two, maybe there's going to be, this new administration will be pro-growth, and that's good. And then, maybe on a regulatory perspective and on a tax perspective, pro-growth and pro-business and pro-investment. So you feel some of those tailwinds out there in the marketplace. Tough to quantify, but I would have expected the UMich expectations data, again, which you mentioned, came in materially lower than expected. I would have expected that to be a little bit better to kind of reflect that. So we'll have to see how that plays out over the coming months. But again, the jobs data, very solid. Change in non-farm payrolls came in at 227,000. Consensus was for 220,000, so better there. The revision from last month, remember we had a real crazy month where it was only 12,000 jobs added because of the hurricanes and strikes and so on. Well, that was just revised up by a factor of 3 to 36,000. So that's pretty interesting. The 2-month net revision came in at positive 56,000, and the prior month was negative 112,000.
So this is the last day we get the Fed speak, and then we have a blackout until the Fed meeting. And so, as you expect, there's 4 Fed speakers, and 2 of them sort of see the difference in how they're viewing it. On one hand, you have Michelle Bowman saying that lower rates should be rates should be lowered cautiously and gradually. She does say the labor market's near full employment, but it's the progress on inflation that stalled. Says inflation data next week will really help her make the decision on what to do in December. On the flip side, Austin Goolsbee says that rates will be a fair bit lower a year from now. So we're still getting the whole, like, yes, it's a Goldilocks scenario. Maybe we get a cut in December. It looks like it's pretty much priced in. But the question then becomes after that, particularly now with Bowman sort of pivoting a little bit more to inflation. I keep hearing from investors, too, that what happens if inflation actually rises next year? And as we heard earlier, do we need some dry powder for that?
Well, and I also look at I'm going to look at the mortgage market, 30-year fixed mortgage, 6.69% off that peak from just a couple weeks ago, but still well above where a lot of folks would like to see
Paul.
it.
By a lot of folks, he means himself.
Exactly.
Coming up, all right, Munis in Focus, we'll be talking about the Muni market, plus Nathan Dean of Bloomberg Intelligence on D.C. policy.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stock averages, right now they have turned mixed. In fact, the Dow is in the red right now, down about 70 points, down 0.2%. Data today suggested the job market remains solid enough to keep the economy going, but not so strong that it raises immediate worries about an increase in the rate of inflation. Lululemon stretching 17% higher right now following its profit report. It said stronger sales outside the U.S. helped it in particular. The earnings topping analyst expectations. It right now is the best performing stock of the S&P 500 again, 17% higher. And the news of the morning, the federal appeals court upholding a federal ban on TikTok, which is poised to take effect in January, though the case is likely to go all the way to the Supreme Court at this point, and it remains to be seen if President-elect Trump can preserve access to the popular app. Right now, the S&P 500, 10 points higher. Again, that's pairing the earlier gains of 0.2%, but still on track for another record close, 6,085 on the index. The NASDAQ 100 up 132 points. That is a rise of 0.6%. Wall Street's fear gauge, the VIX, right at 13. So that is down again today, moderating. 2-year yield, 4.10. That's down 4 basis points. The 10-year yield, pretty much unchanged, and that is at 4.16. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, Focus on Munis is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit BAM Bonds.
BAM!
They rewrote the copy. They took out the whole BAM effect. I think they may have done that on purpose. But anyway, you can visit bambonds.com, and that's where you go there. Let's check in with Martin Braun. He's a municipal finance reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. He doesn't mail it in. He comes into the office. Martin, talk to us about what's happening in the municipal bond market this year, where I see actually some actual positive returns across broader fixed income. Is the municipal bond market participating as well?
It is, yeah. Munis, investment-grade munis are up about 3% this year, and high yield has done really well, 8.3%. And high yield in corporate bonds has also done really well. So there's been, reach for yield and a lot of issuance this year. It's a big year for supply. We had a lot of states and local governments trying to get their bond sales in before the election. And it's a record year this year, and they're forecasting, analysts are forecasting an even bigger year next year, 2025.
So, of course, Citigroup gets out of the municipal bond underwriting business.
Oh, there you go.
Nice
good
move.
timing.
Jeez.
We have a lot of money on the sidelines, like in money market funds and also in high-yield savings accounts, but those rates are now coming down as the Fed cuts. Does that money go into a place like munis?
Well, I think, you can still get very attractive tax-adjusted yields with munis, on the long end. And, credit quality is still very good. It's not peak, but, the municipal market overall, finances are pretty strong. I mean, New York, we just saw bonuses, and Wall Street is having a very good year this year, and that's good for New York City and state tax receipts. California forecasted a big budget deficit earlier this year, but has come back because the stock market has done so well, especially tech companies. So credit quality is good. I think there's still demand for munis.
All right, here's a story that caught my eye a couple of days ago. Blackstone refinances debt for luxury New York City condo tower with municipal bonds. I'm like, who's the reporter on that story? Turns out it's you. What is Blackstone doing with municipal bond markets and commercial mortgage debt?
Bank of America used Liberty bonds to build their headquarters near, Bryant Square. Goldman Sachs used Liberty bonds to build their new headquarters on West Street. And there was an allocation of Liberty bonds that went to this tower. It's called Beekman Tower. It's a big rental building down in Lower Manhattan. And that was built by Ratner, FC, I forgot the name of the Forest City. Anyway, Blackstone bought that building and acquired, have the debt on the building. And so they're refinancing now because it's, they could call the bonds and get a better rate.
I mean, this is amazing. It's actually the cool building. I mean, it looks really, really unique from the outside. So I thought that was pretty cool. So why are they issuing bonds here? Why weren't they issuing bonds a couple of years ago, these municipalities, when rates were a fraction of what they were now? Or they just issue when they need them, I guess?
Yeah, I mean, there was a lot of issuance, when rates are low. I mean, the reason volume is up too is because things are just more expensive. It just costs more to build, infrastructure. So you're going to have higher dollar volume.
Mm-hmm.
But the bond in the case of the Blackstone case, those bonds weren't callable until this year. So, all
right, good stuff in the municipal bond market. Martin Braun, thank you so much. We appreciate that. Martin Braun is the municipal bond finance reporter for Bloomberg News, joining us here in a Bloomberg Interactive Brokers studio. We're going to go down to Washington, D.C. We have to. Stuff's going on down there. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, is going to join us here. Nathan, talk to us about some of these recent appointees here. David Sachs as White House AI and crypto czar. I didn't know that was a thing. What's going on down there?
It wasn't a thing until President Trump decided it was going to be a thing. But, what we should know with czar positions is that it's one of the most difficult positions in Washington because you're tasked with developing policy, but you don't have the teeth or the ability to implement anything. So in this case, I think what David Sachs is coming in is really just going to try and be the cheerleader for the crypto and the AI industry in Washington. Mm-hmm. And I think a lot more of that work can actually be on the artificial intelligence side as opposed to the crypto side. There's a lot of crypto cooks in the kitchen here in Washington already, but when it comes to AI, that's something that Washingtonians really don't understand all that well. So I think a lot more work will be trying to develop what is the U.S. policy AI, and are any guardrails needed to deal with it?
Just some breaking news for you. Just want to jump in. Apple is planning 3-year modem chip rollout, and this is a bid to outdo Qualcomm. This will be the first in-house modem chip to debut in 2025's iPhone SE, and the goal is to overtake Qualcomm's modem technology by 2027. They're going to continue using Broadcom and Skyworks parts in its devices, but will slowly displace parts from Qualcomm and Qorvo. I should point out Qualcomm stock drops like a stone, off by 1.2% right on that news. Apple stock holding firm, up by about 0.2%. Nathan, the energy in the market was, hey, crypto is going to the moon. We're finally going to get a light hand, whether you're looking at Paul Atkins or you're looking at David Sachs. Is that true from where you sit?
So it really depends on 3 things, I think, that are impacting the crypto industry. First is, you mentioned Paul Atkins at the SEC. The first thing that he's going to do is he's going to pull the albatross, the enforcement action albatross, off the cryptocurrency's neck. So there's going to be a lot less enforcement risk for firms like Coinbase and Robinhood. And we saw some of their stocks move as a result of that. The second thing is you're going to have Congress come together and create a bill that provides this regulatory framework. But this is going to take time. I think it's going to take at least a year, if not longer. And again, that's going to impact the more industrial side of crypto. Now, what is most important, I think, for the retail, the consumers of cryptocurrency, is this idea of a sovereign wealth fund. The United States buying 5% of the cryptocurrency of Bitcoin in particular. This is something that Senator Lummis of Wyoming has been pushing for. And I think if President Trump were to embrace that, again, it would probably take an act of Congress. That's something that you would see more impacting of directly the Bitcoin commodity itself, as opposed to the firms that deal within the space.
Nathan, what's the latest on some of President-elect Trump's nominees for cabinet, particularly, I guess, one of the more, that's running some problems is Pete Hegseth for defense secretary. Where do we stand on that?
Yeah, so, obviously, Pete Hegseth is still trying to make his way through Capitol Hill. He was up on Capitol Hill this week talking to senators like Joni Ernst in particular. And I think a lot of folks around Washington think that Senator Ernst is the one that really can make or break his nomination, just due to the fact that she was an assault victim and also part of the military, and that she can provide a lot of cover and or sink that nomination. But what I would just say is just remember that we have a long time until January 20th. And so even though Congress is here right now, they don't want to be here. I mean, they want to go home for the holidays. And, certainly with the government shutdown coming up, if they were to, kick the can, if you will, into March, I think you're going to see a lot of the momentum, if you will, on these nominations just hit pause, and then they'll start again in January. And, but we have seen reports from Bloomberg News that President Trump is floating alternatives. So I wouldn't be surprised if we get an alternative pick in January as well.
Going to the Department of Government Efficiency, which we've talked about for the whole show pretty much, Elon Musk and Vivek Ramaswamy were meeting with members of Congress yesterday. Did we learn anything about what was going on there?
Yeah, so one of the things that Vivek Ramaswamy said is that he wanted the REINS Act, R-E-I-N-S, the REINS Act to be a part of his plans. And what the REINS Act does is it essentially allows Congress to disapprove or approve any regulation. But the thing here, and this is where you have to understand, Bob, the DOGE committee, if you will, they're not a government agency, so they don't have a lot of power, and they rely on Congress to implement those visions. And nearly all the things that they're talking about require a bipartisan act of Congress. So the REINS Act in particular, you need 7 Democrats next year to go along with you. And they only had 1 Democrat vote on it in the House last year. So most likely not going to happen. But I think the other question a lot of people have been talking about in terms of the DOGE committee, if you will, is this idea of impoundment. Let's say Congress appropriates bills to, or, appropriates funds to agencies, and agencies just say, fine, I'm not going to spend it. Well, that's called impoundment. And a lot of that has been dealt with the Supreme Court. And there's this idea out here that even impoundment is something the president may not get away with. So we're beginning to think that the DOGE committee, if you will, is more of a PR exercise, something to keep in terms of the campaign for the 2026, because